Friends, very happy evening to all of you. I welcome you all to this Metro conference, the conference which was initially thought to plan for members in Chennai who could not attend the regional conferences, and then they could have a program in Chennai. But thanks to this pandemic, there's no difference between regional conference and the Metro conference. But nevertheless, we thought we will kind of conduct this program with the best of the speakers and the contemporary topics, so that we are able to disseminate knowledge on what is required today. So appropriately, we have with us our beloved past president of ICAI, CA BP Raoji, where on 2 occasions we could not get his dates, but today we were fortunate enough to get his dates, and he's amongst us to share his thoughts with us. Also joining with us is a beloved speaker, CA Venkataramani sir, who is a well-renowned and sought-out speaker when it comes to GST, where we are eager to listen to him. He's going to touch upon the important issues in ITC under GST. In fact, there are so many issues, and ITC has got the most, so we thought it is most appropriate to cover that. And very important person also joining is Treasurer of ICAI, CA Geeta Madam, who is going to share her thoughts as well. So as we take things forward, I request first CA Abhishek Murli to introduce our chief guest, CA BP Rao sir first. Abhishek, over to you.
Thank you, Chairman. A very warm good afternoon to all the participants who have joined in today. Chairman of SIRC, CA Dungarchand Jain, our past president, CA BP Rao sir, Treasurer of SIRC, CA Geeta ma'am, and renowned speaker, CA Venkataramani sir, all the participants who have joined in for this important Metro conference. As Chairman very rightly said, today non-metro, metro, Chennai, Bombay, Delhi, we don't have any boundaries. So geography has now become history. So we're enjoying the presence of the best speakers at all conferences. And I think the Metro conference, it symbolizes what the chairman very rightly said, as it was supposed to be meant for a purpose where the Chennai members or the Metro members who missed a certain meeting get to compensated through this. But it is now yet another opportunity for us to meet together and interact and listen to some of the best speakers. I have the privilege of first welcoming and introducing our past president of ICAI, CA BP Rao sir. CA BP Rao sir is a commerce graduate and secured the 4th rank in BCom in Mysore University and passed out as a CA in 1976. He is also a law graduate and hails from Mangalore district of Karnataka. He is closely associated with the development of ICAI through the regional and central councils, and he was the president of the institute during 94-95. He represented ICAI in the council as IFAC from 1995 to 1997. In fact, even though his profile does not say this, he was one of the youngest presidents in the history of our Institute of Chartered Accountants of India. And it's a huge privilege for him to have achieved that sort of status, and it's a huge privilege for us to have him with us. So he is a founder of a very leading firm of chartered accountants in Bangalore, Chennai, and Mysore, and is also a director on the board of Numaligarh Refinery Limited. He was the chairman of BGSE Properties and Securities Limited, and earlier he was in the board of State Bank of Mysore for 6 years and BDELF Electronics Limited. He was an independent director of BEML during the year 2015 to 2019 and also chairman of the audit company. Now he has more than 44 years of experience as a chartered accountant in the fields of statutory audit, taxation, income tax representation, bank audit, due diligence, consultation, and specialized drafting when it comes to memorandum of understandings and joint ventures. This is only a brief profile. In fact, I can say, as I was just telling before the meeting started, my first interaction with BP Rao sir was when I was a 7-year-old child. And back then he was invited as a chief guest when my father was organizing a program, a residential program in Ooty. And even then he was the life of the entire function, a very lively, energetic person. I still remember that. And I think that memory does not seem to have changed every time I have met him or seen him since. So thank you so much, BP Rao sir, for accepting our invitation to be here today. We're really looking forward to your address.
Thank you very much.
In fact, Abhishek, BP Rao sir's experience is my age, and yours is still lesser actually. And with the limited interactions I had with BP Rao sir, he's still young at heart actually, let me tell you. That's his specialty. And one more observation which I just noticed now, the speaker, the chief guest, and the panelists. All the three are from Bangalore. It's a pure coincidence. We never thought that it will happen this way. It's just a coincidence.
Good.
Maybe also we are eager to listen to you, sir. Please.
Okay. Sir, not only to add on to Abhishek's introduction, I would like to add, as a Bangalorean, proud Bangalorean, along with these two eminent personalities, BP Rao sir was instrumental for our Bangalore branch building, sir. Then he was chairman of building committee, and he pulled all the funds. Those days, they worked 24/7. Compulsorily every Sunday they were meeting in their office to get the progress of the building, and they completed our Bangalore. The Bangalore branch is the biggest branch, as everyone knows. But behind the Bangalore branch, these persons or eminent persons are there, and BP Rao sir, whenever we ask him for any help regarding institute matters, for in sponsorship or for any other advisory matters, he'll be there for us. So even Venkataramani sir also, for that matter, these personalities are backbone for our institute, sir. Thank you.
Yeah, as rightly told by Geeta madam, getting those buildings on those days was not that easy as it is today, because it was with a lot of struggle and difficulties. We understand the pain and the time which people would have spent, and today we are able to enjoy a lot of this infrastructure as we stand today. We will also over
and even sir, and even he introduced a student education fund for the purpose of providing free coaching classes for the students.
Wow, wow,
wow. Okay. Shall I?
Yes, please, sir, please.
Good evening to all my professional colleagues. Respected Chairman, Mr. Jain. He is of my age of practice, 44, I think. He is a very dynamic chairman. And Mr. Murli, Abhishek Murli, is always smiling, energetic, young secretary of SIRC. Our Geeta madam, she's also always smiling. She's so good, actually. She has come up from the Karnataka State Chartered Account Association to the branch, Bangalore branch. Then she has gone to the SIRC and elected as a treasurer. And one day I'll definitely see her as the chairperson of SIRC. Then thereafter she should go to the Central Council. See, her two daughters, they are chartered accountants. Okay, 2 years back they qualified. Really fantastic. That way we should appreciate her determination. And really fantastic. So thank you very much, Geeta madam, for being with us today. Okay, I'm really appreciate your concern for us. And Mr. Venkataramani, special namaskaras to you. Really, I am very happy that earlier also once we had an interaction through this webinar in Bangalore. It's really fantastic. Today I am not able to stay for 3 hours with him. So pardon me, Mr. Venkataramani. So now, thank you very much for all your good words about me. I don't know whether I deserve it or not. Yes, Murli is a very close friend of mine, and 44 years of practice. And at the young age, I become Central Council member. It's all God's grace, and also whatever thing in it happened. That's the thing. Not everybody will get it. I got it. It's something I could do for our institute. As a branch, as I also said, because of the cooperation from the members of the Bangalore branch, we could achieve it. Those days, I used to get the checks from the members. That also total project is about, I think, 80 lakhs or so. And you could get the check. I used to take to Delhi and got their 100% deduction under section 10 or so, 1013 or so. Sorry, 1023 for our institute, from the institute, so that members could donate more and more funds to our building. And we have completed in 13 months. Many members have helped us a lot, actually. So this is the thing. There's nothing great about that. So having you raised the issue, then I am just replying. Right? And see, I think the SIRC, they're doing a great job. Just I gone through your seminars during this COVID pandemic. Okay, I think I conducted more than 140 programs in a year. And the chairman earlier told me that 1,20,000 hours given to the members of SIRC. It's something fantastic. Every alternative day there is a program. And now it's now 4 days continue, 3 days continue. Today, tomorrow, day after. See, but institute is so lucky to have such good members. Always I think in Bangalore, one chairman is doing extremely good job. And I was thinking the next chairman, whether he will be doing the better job or no, I may not come up to the level of the previous chairman. Believe me or not, last so many years, I'm finding better chairman every year. Is it possible? I don't know. They get automatic energy from the previous chairman. They would much, for example, Ravindra Kore. And he has done extremely good this year. Earlier chairman also done very well. And incoming chairman, Mr. Shetty, will also do very well. So that way, our members and the institute is lucky to have such members. And another thing I have seen, the institute is like a temple for us. Everybody respect that this one. Okay. Other day I was seeing the some video in WhatsApp. Somebody has took our Indian flag to the public, and he said, if you tear this flag, I will give you 500 rupees. He has gone. He goes to 10, 20 people. Nobody is ready to accept 500 rupees and tear that flag. Likewise, today, if we take our institute symbol, okay, if we say something, no member of our institute will agree to do anything harm to our profession. That way, one thing is very good. And all of us know that, now 3 lakh plus members, our livelihood, our coming up in our life, it's all because of the one logo at the Institute of Chartered Accountants of India. And I am very confident that even new members also have the same view, and every member who are associated with the institute, either in the council or in the region council or branches, they will never harm our institute's name and profession. Even every member will try to keep the respect and trust of the institute. That I am very confident. That's why today what we are today, actually, it's a fantastic. Okay, and of course, now the 3 days program, Mr. Venkataramani will ITC the GST will talk on that. It's a very vast subject. I think there will be so many issues will be there, and 3 hours it may not be sufficient for him. But another thing is now GST audit itself is taken away in this budget. Budget has created a little bit a problem for the chartered accountant profession, but not now. The once GST is introduced, everything has changed. For example, tax audit. Tax audit 10 crores. If your digital transaction is more than 95%. It's all because of the GST, because they don't require every information the government gets, and through that you will get to know everything. So audit, especially for reconciliation, other things of GST, it's not necessary. GST audit gone. Like tax audit also, it's not necessary, because now one is nowadays what you are hearing is one is cashless, another is faceless. Two things has created a lot of problems. See, even tribunal members who are depending on the tribunal practice, that also they may find it difficult in future, because that also becomes faceless. And according to me, this has started not now, since the last 10 years going on. The scope for the chartered accounts is coming down day by day. Next, after 2 years, I doubt whether we will remain to as a tax auditor to file the IT return. That also may not be there, because 50% of the SSCs, they need not file the returns, because automatically this one form will get, just you have to sign and send it to the department. I don't know the correct name, but it's going to come. So our practice mainly should depend upon only the audit. Audit, big fours are, they are getting bigger firms. I know nothing to say about that. But smaller firms may not get like big audits, because it may be difficult for them, for the client also, big clients to come to the small firms. That's also there, small practice. As you know, the bank audit, number of bank itself has come down. Branches also will come down, and audit also has come down. Branch audit also will come down. Many of our members every year they depend so much on the bank audit. Now that also will come down. So what is the new avenues for us? I think is very challenging. The profession is a challenge for the members to continue in the profession. but it is very important that we can come up every time we face the challenges. Tax authority was there up to 40 lakhs about 5-6 years back. Then it is increased to 1 crore, then 5 crores, now 10 crores. Okay, but still we are survived. There's nothing in this one. But there is a lot of scope for members for employment. That I am sure that the chartered accountants, the syllabus itself is so good, and the hard working what they put, they will come to know so many, I mean, knowledge will be excellent. So every employer will employ this chartered accountants. So there will be a very good scope for chartered accountants in industry. This one, but according to me, we should be a business consultant. Okay. Now we must join with the business, and you must tell them, okay, how to cut the cost, how to improve their business by introducing technology. You know, the technology also has created a lot of problem us, but technology has created a problem because of technology. Economy is growing. So we can't blame the technology. Instead of that, we have to ourselves we have to adopt this technology and implement in our profession. That is very important. That's why I'm very happy that tomorrow there's a subject called blockchain and cryptocurrencies. That's also very relevant for the profession. And another session is there on that. That's on relevant on
Income
the
tax private.
that's the artificial intelligence of the professionals. That's also very important. See, artificial intelligence we have seen in the last so many years. Now, earlier, you know, when I started practicing in 76, big ledger used to come from a client and used to take the colored pencil and used to watch and used to stick and totally in the paper and I used to say, call the typist and he used to type the trial balance. Then from there, balance sheet, profit loss account, and filing the return. So everything is manual. In 1976, it went up to 1980 or so. And at that time, to get a phone, you used to wait for about 3-4 years after paying 30,000 rupees. Today, we can get the phone within 5 minutes. You take the Aadhaar card, go there and you can get the phone. So many changes have happened during this last 45 years. I witnessed all these things. I'm sorry. So these are the changes going to happen. Earlier, our main job was to, after filing the returns, go to income tax. I used to go during somewhere in 85, 80 to 90, 4 days in a week in the income tax department, taking the notice, meeting officers, wait outside for hours together, come back. So these are our life was like that. Today, we need not meet anyone. But this COVID pandemic also made us not to meet anyone. Now, today we are discussing and we are seeing each other through the laptop. These are the changes which has taken place in the last last few years. So I think I'm sure youngsters will cope up with the developments and definitely they will do well. Absolutely, there is no problem. I'm very confident. And there's so many other avenues available in valuation, mergers, due diligence. Then new things will come up for a forensic audit. So many things will come up. So we have to. So you have to accept the fact that changes is already there. Changes will come. We have to come up. That's the only thing. So I think, Mr. Chairman, thank you very much for inviting me to this seminar as a webinar, as a chief guest. Thank you very much, Murali, for your involvement in each and every programs. I think Chairman Murali and Chairman's face, I'm seeing almost in every seminar. Today I'm happy that Geeta Madam also here. So Venkataramani, so I'll thank you very much for accepting invitation of Chairman, and members will be very happy to hear you for 3 hours. So with this, I conclude my speech. Thank you very much. All the best. Thank you.
Thank you, P.P. Rao, sir. Those were the pearls of wisdom, actually. And people will appreciate why we ask past presidents and people who have led the institute in sometime in the past, who are able to appreciate what happened then and what is happening today. Thank you so much for your kind and gracious presence, sir. We are looking forward to invite you someday to Chennai as well as to Madurai when things get back to normalcy.
Yes, sir. Thank you. Thank you very much. Yeah. Thank you very much. Yeah. Madurai, I can't forget because I planted some coconut trees there. Madurai branch. I can't forget.
Yes.
Yeah. Okay. Thank you.
Thank you, BP Rao sir. Thank you. So before we request the speaker to speak and get the speaker introduced, I will request CA Geeta AB, our treasurer of SIRC, to share her thoughts with all of us. Geeta ma'am, over to you. Ma'am, you are not audible.
You are not audible, ma'am. You have to unmute.
Yeah, you just unmute and speak.
Yeah. Hello. Sir, am I audible?
Yeah, you are audible now.
Yeah.
Yes.
Happy evening to all members virtually present here to this Metro conference. Talking about today's session, it is about input tax credit issues, aptly chosen topic for this Metro conference, and also need of the hour. As we deal with the GST filings, we have come across various intricacies in the GST, and for instance, we are still looking for an option to reverse the output tax paid in GSTR 3B. So there are such n number of issues, and it requires no special mention that to reconcile these differences is a Herculean task. So I'm sure today's speaker, our Venkataramani sir, who is popularly known in Karnataka as a walking encyclopedia for indirect taxes. And I'm proud to share that he is one among the team members who have submitted the research paper before introduction of GST. We have submitted our recommendation from our institute. So he was also one among the team member. Venkataramani sir, I'm sure that he will have lot of inputs to share to enhance our knowledge with respect to our GST input tax issues and practical difficulties faced with regard to the tax credit. With this, I wish you all the viewers a happy learning experience. Thank you.
Thank you, Geeta ma'am. I think she has done her role as a treasurer properly to tell the difficulty she is facing. Of course, in SIRC, we don't face those many ITC issues, but she has rightly did her job as a treasurer. And if I may call Venkataramani sir, as far as it comes to GST, he is the Bhishma Pitama of GST. Or any topic, any difficult topic you can get him, and he'll be able to deliver the best. I must say this, sir, today. And before I
Sir,
request
he is a powerhouse, sir.
Yes,
he is a powerhouse, sir.
And Bhishma Pitama covers everything. There cannot be anything left, actually. Yeah, Abhishek, over to you so that we can get the speaker introduced formally.
Thank you, Chairman. Thank you, Geeta ma'am, resourceful treasurer, for the perfect introduction. And as rightly put by both Geeta ma'am and Chairman, input tax credit is a highly controversial and a topic where people constantly have doubts. Though GST, if you talk about GST this year, the only thing people are talking about is how the GST audits have suddenly gone away. But you'll still have input tax conversations despite that. Let me tell you, yes, audits have gone away. It is a hit for our profession this year, even though COVID has happened, that came as a rude shock this year. But I'm sure, from a consulting point of view, today's inputs will go a very, very long way in providing you more professional opportunities. And to give an incisive analysis on this, we have with us CA Venkataramani sir, and I have the pleasure of introducing him. He's a chartered accountant, a graduate in science, and then he pursued his chartered accountancy course. He was in independent practice and now has joined a very leading firm. He is practicing in the field of indirect taxes and has been mainly involved in indirect tax planning, representation, and appearances at various levels. He's a regular speaker at various forums and has presented a number of papers on indirect taxes, both at the state and national level. He's an author as well. He has co-authored 3 books. One, a handbook on value-added tax. Second, audit under the Karnataka VAT laws. And third, a discussion paper on the key transitional issues in the GST regime. He's also served in various capacities at various professional bodies, executive member of the Karnataka State Chartered Accountants Association, member of the GST Committee of the ICAI, co-opted member of the Fiscal Laws Committee, State Taxation Committee, the GST Subcommittee of SIRC of ICAI, he is an indirect tax committee member in ASSOCHAM, a member of the GST committee of the All India Federation of Tax Practitioners, a co-opted member of the indirect tax committee in New Delhi, and a special invitee as well over there. Presently, he is a member of the Fiscal Policy Institute of the Government of Karnataka, involved in the structuring, designing of the course curriculum for commercial tax department itself, a regular faculty at various branches and at the SIRC level and at the ICAI level at our institute, and a member of the State Advisory Committee for GST for the Government of Karnataka. Because I'm sure this is only a brief profile, as the chairman and Geeta ma'am both rightly put, sir is a doyen of the profession, and listening to him is always a very, very enjoyable thing. So thank you so much, Venkataramani sir, for accepting our invitation. It's always a pleasure to listen to you. We're looking forward to your session today.
Thank you so much. Abhishek, we start.
Yes, sir.
Yes,
Yes,
sir.
Venkataramani sir.
Thank you, Chairman Dungarchan Jain. Abhishek, although I've seen you so many times on so many sessions, I have been part of several lecture sessions with your father. So I remember the way he introduced me once in Chennai. If I remember right, it was Rani Sita Hall, and I'm not sure whether he was the chairman then or whether he was the secretary then. I exactly don't remember. So when he introduced me for those speakers, I cannot forget that time. Geeta madam, of course, I've been seeing her for such a long time, a very, very hardworking person. I wish all the three of you success. I want you all to move to Central Council and probably be the torchbearers of this prestigious association. I'm sure one of you of the three or all three of you will probably be the president of the association in the years to come, and I'm going to see that time too. Thank you so much for this introduction. BP Rao sir has said some very good words about me. I don't think I deserve any of it. I'm a simple chartered, I'm a small time chartered accountant practicing in the areas of indirect taxes. I just do what little I can and leave the rest to the department first and God next. Let's see what happens. Today's session is important. It's very, very important in the sense that the topic that's been assigned to me is to call out the issues. As a part of several committees, I would be failing in my duty if I were to talk only on the input tax credits that are available and the documentation part or the procedural part that would be there. I think I should forewarn the members of what is coming over the next 2 to 3 years. This is what you need to gear up to. I would want all the members who are present here who are listening to me that the issues that I'm going to take up now are some of the largest issues that you will be litigating over the next 2 to 3 years. It is not that the government is not aware of these issues. The government is aware of these issues. Some of these issues have already cropped up in several states, although the issue has not blown out of proportion. Some of these issues are issues that are created by the government for the law to settle. They want the law to settle, so they will create these issues. Some of these issues are business related issues. Some of the issues that I would be perhaps talking about are things that as indirect tax practitioners we don't pay attention to. If these issues probably come up at the audit stage by the department, it will go out of control. I would want you to pay attention to each of these issues that I would be talking of. The rest of the procedural issues, I will share it with the SIRC of ICAI. Those are the issues relating to rules, section, basics of input tax credit, etc., which I don't want to waste time. I think we will now move to the next level to get the members ready of what is in store for us in respect of GST training. Now, let me start with one of the issues with which I was stuck. One, in the last year or so, I happened to be doing the audit of a jewelry entity. Jewelry entity is a fact, but I really don't want to belittle the jewelry business or anything like that. This is an entity which I audited. I came up with this issue, so I thought I will bring it up. Not that this issue will not come up somewhere else. It will come up in all businesses. So when I was conducting the audit of this jewelry business, I suddenly looked at a credit balance of input tax or an input tax credit in respect of insurance. Be careful, I'm talking of input tax credit in respect of insurance of close to 1 lakh and odd. That means I was just wondering what must be the premium that is paid, what must be the sum assured that comes up, and therefore I thought let me have a quick look at what is in store. Give me 1 second if somebody can help me to figure out whether my screen is shared.
Sir, it is not currently shared. We are not able to see it.
Shared.
Now it's visible.
Now it's shared. Okay.
Yes.
Yes.
Sir, you
So
can
when I
put
was-
in the full presentation mode, Venkataramani sir.
Slideshow.
Yeah,
Now is it?
yeah.
Is it?
Slideshow.
Is it in slideshow now? Not yet.
No, it is not in slideshow. You have to click slideshow.
Let's figure. I just put it on slideshow. I don't know. I'm not able to handle this.
No,
Let
sir,
me
click
figure it.
F5, sir. Click F5. Yeah,
Yeah,
now
it's Yes, I'm only hoping that you'll also be able to see me. Yes.
yeah, we are.
Yes. Now, when I was checking this insurance input tax credit, I was a little surprised to figure out how can somebody have an insurance credit of a jewelry entity aggregating rupees 1 lakh plus. So when I went into it, I figured out that the sum assured in respect of stock was close to 5 crores. So an average stock carrying capacity of that entity was aggregated rupees 5 crores. So I said, let me look at the stock in hand. So I looked at the stock in hand when I prepared the monthly trading accounts, etc., to figure out whether an average 5 crore stock would be available. I understand there can be peak stock, there can be the lowest level of stock, etc. But somewhere the average stock should come to 5 crores. Otherwise, the businessman would exercise his prudence to reduce the quantum of insurance. So I picked up the previous year, it was insured for 5 crores. A year earlier, it was insured for 5 crores. So the average stock that was carried by this jewelry entity in the books was an aggregating close to about 1 crore, crore and a half, not exceeding 2 crores. Peak credit did not exceed 2.25 to 2.5 crores. So I said something must be wrong. So I asked this gentleman, why did you insure for 5 crores? When your average stock carrying capacity is not more than 2 to 2.5 crores and you happen to be a very small showroom, why would you want to carry this stock? He refused to answer my question. He did not look at it at all. But then I realized that there was a not just substantial, huge difference in stock between book stock and physical stock. That is when I realized that chartered accountants should not just look at the paper in front of them to figure out whether input tax credit is available or not available. You should also go into merits of the transaction to figure out whether credit is actually eligible or not eligible. Why I am giving you this example is you can come up with hundreds of explanations to say fee is not commensurate with the work that we do, auditors are not bloodhounds or watchdogs. I understand all of it, but I think most of all, as our former president BP Rao said, time has now come that we should act as business consultants. Time has now come that we have adequate common sense. Your chairman Dungarchandjan said that most of it should be logical. So there must be something called logical, thereafter legal. If something is not logical, definitely it will not be legal. Let's get clear about that. So we have to be careful when we exercise our discretion, when we exercise our due diligence, when we exercise all the legal provisions, or when we put into practice the entire legal statute to figure out whether tax credits are available or not. So this was one part of it I thought I will commence with before I get into the several issues. Now, those of you who practice company law will know what is notes to accounts or connecting statements that some people colloquially call as. There are notes on accounts and there are notes to accounts. I understand both these completely differently. Notes to accounts and notes on accounts. Notes to accounts is something which the statute requires. Notes on accounts is something which the chartered accountant gives to make the reader better understand what is present in the financial statements. Now let's have a look at this. Government has started looking at these notes to accounts, notes on accounts, and connecting statements. Let me tell you what the government is looking at insofar as input tax credit is coming at, and so far as input tax credit is concerned, and how they are using the artificial intelligence that is available with them to data mine and raise issues. One of the audit reports that was signed by a chartered accountant had a note which said revenue is recognized on dispatch of goods. This was a simple disclosure that was made in notes on accounts. He said revenue is recognized on dispatch of goods. Nothing wrong. The chartered accountant has made the disclosure. He has done his job. He's perfectly done his job. He's more than done his job. But look at my difficulty. My difficulty, as far as the GST consulting or input tax credit on GST is concerned, is to give effect to this note fully and completely. The revenue is recognized on dispatch of goods. This is the note. What does this mean? That means invoice may have been raised on 31st of March, but the dispatch may not have taken place. Dispatch may not have taken place. Invoice is raised on 30th of March, 31st of March, or month ending on any day, or during the month. Invoice may have been raised, GST may have been paid, GST may have been paid, the relevant turnover may have been declared in GSTR1. It will also appear in GSTR2A in the recipient's hands. All GST requirements and nuances are completely catered to, so there is no requirement to be alarmed at all. But the difficulty doesn't lie there. The difficulty is in respect of input tax credit that will be claimed by the recipient. If the recipient is going to claim input tax credit based on the credit that is available to him or reflected in GSTR2A in his portal, on the website, on the web portal of his GSTR account, unfortunately it will be wrong, because you will not be fulfilling the conditions required to avail the input tax credit. You will not be fulfilling the condition relating to availment input tax credit. When can you avail input tax credit? Be careful. I'm using the word avail with some sense of responsibility. You can avail input tax credit on fulfillment of 4, now plus 1, 5 conditions starting this month. What are these 4 conditions? Possession of invoice, receipt of goods or services, or both, filing of return, payment of taxes. Now look at this. You will possess an original invoice because you have received the invoice, but the goods are not dispatched. Be careful. You have received the invoice, but goods are not dispatched, right? 2, and goods are not accounted in the financial statements because revenue is recognized on dispatch of goods. Be very careful. 2, taxes paid, return is filed because invoice is raised, GSTR1 is also uploaded, appearing in 2A, but credit is not available. So the artificial intelligence or the audit wing of the Goods and Service Tax Department have now started reading and understanding the notes to accounts. They started reading and understanding. Second note that can probably appear is revenue is recognized. First one, revenue is recognized on dispatch. Second, revenue is recognized on appropriation of goods to the contract. Revenue may be recognized, which means your financial statements may show a higher income, higher sales, higher revenue from operations. It may show because the goods are appropriated to the contract, but invoice is not raised, tax is not remitted, dispatch has not happened. Goods have just been appropriated, manufactured, appropriated to the contract. That means I manufactured 10 pieces, appropriate these 10 pieces, and say Chairman Dungarchand Jain's purchase order will be catered to by these 10 pieces, which means revenue gets recognized, dispatch will happen in the subsequent month, invoice will be raised in the subsequent month, tax and return will be paid and filed in the subsequent month. Credit will not be available. In such cases, be extremely careful that there can be an impact of output tax. A month earlier, and the government may come at you on delay in payment of taxes, and therefore they will tell you, please pay your interest in accordance with this, right? This is the first part. The second part of this connecting statements and notes to accounts. Most chartered accountants will make innocuous disclosures. Innocuous. For them, it is routine. For them, it is a requirement under the Companies Act or the income tax law or under some other statute. For the chartered accountant who signs the financial statements, he makes these disclosures under allied laws. Now, to give you one such disclosure, there is no material discrepancy in respect of the stock. Discrepancies noticed have been appropriately given effect to. Now, this is the disclosure. Now, the government believes crores of rupees worth of stock have been suppressed, evaded, avoided, misstated, or credits have been availed where you are not entitled to, etc. So, as a chartered accountant who is going to be a GST consultant, be extremely careful in these cases. They will tell you to reverse input tax credit if you have not received the goods, if these goods have not met the end use criteria, because input tax credit will be availed for when output tax becomes payable. When output tax does not become payable, it becomes extremely difficult for you to prove that this input is in respect of or for the purpose of or intended for furtherance of business. It is going to be extremely difficult for you to prove this case. Importantly, in case of stock shortages, which can be on account of normal loss, abnormal loss, pilferage, wastage, unusable, not properly accounted, it can be for any reason. The government will tell you that please quantify this and reverse the corresponding input tax credit. That will come with consequential interest and penalty. So I gave you some 2-3 examples in respect of the way the government is looking at the issue relating to input tax credit. Now look at the basis of information. I believe that the basis of information provided is not in alignment with the goods and service tax law. A chartered accountant who is practicing Companies Act discloses information in the financial statements as required under that particular law. If it is not a company, a chartered accountant in practice who signs the financial statements of a business entity discloses under that appropriate statute. It can be a society, it can be a bank, it can be, I don't know, club, it can be 44 a normal person carrying on business, etc. So you disclose, keeping in mind one particular statute or a few particular statutes, but overall, the healthy practice would be to align the information with all laws which impact the tax, Accounts based on accrual and matching concept. I don't need to tell you what this means. Accounts are based on accrual concept and matching concept. There is absolutely no difficulty at all. But the difficulty arises when accounts are not based on accrual and matching concepts. For instance, accounts are reported on cash basis. Because we are chartered accountants, I am trying to disclose to you here that most contractors disclose their receipts on cash basis. It is not on accrual basis. When I talk of contractors, I am talking of contractors or small-time contractors. I am not talking of builders, developers, the Larsen and Toubros, the Gammon Indias, the Simplex, etc. I am not talking of those entities. I am talking of small-time contractors who do work for the government entities or who are subcontractors for the main contractors, who don't do work more than 5 crore, 10 crore, 15 crore in a year. They raise a running bill, they don't raise an invoice. They wait for their work to be certified. On receipt of money, after appropriate tax has been deducted by the main contractor, disclosures are made in the goods and service tax regime. Unfortunately, that is not how goods and service tax regime looks at these transactions. You can have an output tax liability much earlier than the date on which you receive the money. Now, the difficulty here will be availment of input tax credit, because input tax credit is availed on accrual basis, because the moment you effect purchases, You show your input tax credit, although payments need not have been made. You are following the concept of accrual, but for the purpose of payment of tax on output basis, you are following the cash system of accounting. So you could run into difficulties in most of these cases. Please be very careful when you look at accrual and matching concept. Similarly, child accountants, lawyers, structural engineers, doctors, consultants, whoever, you all follow cash system of accounting. Please look at the matching that is possible or permissible, and thereafter look at availment of input tax credit. GST incidence is based on time of supply. GST incidence is based on time of supply. Now, what is crucial is figuring out what is that particular time, which is time of supply. There is no difficulty in figuring out the time of supply in respect of goods. There is no difficulty. No difficulty. You can look at your e-way bill, you can look at your delivery challan, you can look at your invoice, you can look at, I don't know, lorry receipt, you can look at a lot of other things and figure out whether the goods have really been dispatched or appropriated, thereafter raise invoice, pay output tax credit, etc. But the incidence is based on time of supply concept. When I talk of output tax, you will realize exactly the reverse will apply for the purpose of issues in input tax credit. Let me tell you how the government is tackling the input tax credit here. Now look at the situation where Geeta Madam effects an inward supply from a supplier located in Gujarat, and assuming that the supplier located in Gujarat dispatched the goods on 28th of the previous month. The goods take about 1 week to reach Bangalore from Gujarat to Bangalore. It takes that kind of time. If it is going to take that kind of time, the output tax will be paid by the supplier in the previous month. It will be uploaded in his returns in the previous month. He will upload the data in GSTR1 in the previous month. It will reflect in GSTR2A in the recipient's hands in the previous month, but goods are yet to reach Geeta Madam's hands. You will not be in a position to avail input tax credit in respect of these transactions. There are hundreds and thousands of cases that the department has detected in respect of such transactions, where input tax credit has been availed by the recipient based on the quantum of credit that is reflected in 2A. You cannot avail that input tax credit because you have not received the goods. So be extremely careful when you avail input tax credit. Credit is not available simply because it is reflected in 2A. Credit is available based on fulfillment of certain criteria and conditions. Now, the government is aware that input tax credit has been availed by a good number of dealers, including large companies in India, based on what is reflecting into it. Be careful. Nothing will happen to your credit, but you have an interest exposure because you are entitled to avail. You are entitled to avail this input tax credit in the subsequent month. On receipt of goods. But what you have actually done is you have availed input tax credit a month before. Therefore, exposure to interest is a certainty. Be very careful. The government is now trying to data mine these transactions based on distances. They are trying to data mine because this is available as per your way bills that you have generated or e-way bills that you have generated on the website. It is all available. So they are trying to look at this transaction and the last checkbox that it has crossed or uploaded, and then try to figure out whether credit will be available in the recipient's hand. Trust me, hundreds of large companies have availed input tax credit on this basis. So GST incidence in respect of time of supply becomes crucial. It impacts your input tax credit. It impacts input tax credit. Identify inherent differences based on industry or sector. Now, what the government has been doing here is they have been identifying the differences based on sector and industry. They look at pharma industry separately, they look at consumer industry separately, they look at construction industry, they also look at service industry completely differently. What are the inherent differences based on industry practices? Now, let us take an example of an FMCG industry. For an FMCG industry, sample business promotion mean two different things. I'm repeating again. Samples and business promotion are two different things. Samples for a pharma industry, business promotion for a pharma industry is completely different. I will take up this example when I come to the next slide. But keep this in mind that it impacts your availment of input tax credit, because reversal of input tax credit is also an issue in input tax credit. Now GST has expanded into new areas which was hitherto unforeseen or not seen. Taxable and non-taxable turnover needs to be reported. Taxable and non-taxable turnover. What is non-taxable turnover? Non-taxable turnover means turnover on which tax is not payable. Non-taxable turnover can be petroleum products. For example, petrol, diesel, motor spirit, they are outside the purview of GST. Similarly, alcoholic liquor for human consumption is also outside the purview of GST. But taxable and non-taxable turnover are required to be reported. Now, why is this crucial? Why would it hit your input tax credit? Let us say our chairman, Mr. Dungarchan Jain, is auditing a hotel entity, or is consulting for a hotel, is consulting for a restaurant or a hotel. Now consider the situation. Consider the situation. If this hotel in Chennai or hotel in Madurai is a very large entity, where not just room is available, accommodation services are available, restaurant services will be available, cab service will be available, ticketing services will become available, tourism services will be made available. On top of all that, the restaurant will also serve liquor. Liquor is outside the purview of goods and service tax law. Now look at the input tax credit issue that is arising here. My chairman will tell me, Venkat sir, what is the difficulty you have? Liquor is outside the purview of GST law, no output tax payable, no input tax we will claim. I am not worried about your input tax and output tax because I know liquor is outside the purview of goods and service tax law. But my problem is something else. My problem is reversal of input tax credit or availment of input tax credit. I will tell you to apply Rule 42 and Rule 43, Rule 41 and Rule 42. Reverse your input tax credit pro rata based on consumption of liquor in that hotel. The moment I say reverse your input tax credit based on pro rata consumption of liquor, all your eyes and ears will open. Now, you will say, sir, how can I reverse all input tax credits relating to accommodation services? If you have not maintained accounts in a transparent or verifiable manner in respect of stating that what is the input tax credit in respect of accommodation services and what is the input tax credit in respect of restaurant services, I am afraid it will become a basket and you will have to apply the turnover ratios. The moment you apply the turnover ratio, life will become miserable. Your client will not agree. Why? Because liquor is expensive. Somebody who runs a liquor of 1,000 rupees will run a food bill of only 250 rupees. Reverse is also true. But in most of the cases, liquor bills are higher than food bills. Now, the moment I apply this ratio of input versus output, all your eyes and ears will open. Not just this. Not just this. Look at a situation where a hotel in Madurai or hotel in Chennai has accommodation services, has restaurant services, has bar services, has all other services including GTA, including travel services that are made available, cab services that are made available. The security who lets a restaurateur, that means a security who lets a customer to the restaurant, also lets the customer to go and occupy his room. How do you apportion the input tax relating to security services? Should be based on the accommodation rentals, should be based on the footfalls for the purpose of restaurant, should it be based on turnover of liquor, should it be based on the average of all of these 4 or 5 streams of revenue? Importantly, the person who comes to the restaurant has food. He also drinks liquor. Now look at the situation. Can you say that the table he uses or the crockery and cutlery that he uses for the purpose of consumption of liquor should be restricted? You would be able to restrict that if you are in a position to identify the input tax credit in respect of bar cutlery, you will be able to do it. But otherwise, you will not be able to do it. I will tell you, reverse pro rata input tax credit. What the government is now looking at is in respect of these transactions relating to hoteliers and restaurateurs where liquor is served, whether there is a reversal of input tax credit. If there is a reversal of input tax credit in terms of 41 and 42, right now, they are doing nothing. They are just keeping quiet. However, may I make it clear that in times to come, they are going to look at the manner in which you have reversed input tax credit, whether it is based on the restaurant area, bar area, footfalls, food versus liquor, turnover ratio, accommodation versus food versus restaurant services ratio. How you are reversed is going to be questionable. So availment of input tax credit in these cases is certainly not 100%. There is an element of reversal. Therefore, this is an issue in respect of input tax credit when taxable and non-taxable turnovers are to be reported in goods and service tax law. Look at another business. Today, you have businesses which have ventured into solar farms, windmills, I don't know, electricity from wave energy, call it by whatever name. These are entities which have invested hundreds and thousands of crores in business, who also have other businesses. So you will have to be very, very careful in respect of reversal of common credits. In respect of specific credits, the chartered accountant would have taken care of or consulted appropriately. In respect of common credits, it is a view of the department versus my view. Who is going to have a better way of dealing or better way of stating this transaction? He is the man who is going to succeed. I am not saying that you will lose. I am only saying get your defense ready, because these are issues that you are going to take care of in the years to come. No supply transactions also affects credit reporting. No supply transactions. There need not be a supply. There need not be a supply at all. Even those will affect credit reporting, because certain transactions are not supply. For example, liquor is not a supply. It is a non-GST transaction, but it will affect credit reporting. Now, the biggest problem that I have is the last bullet point that is here. Accounts permit credit in expense account. Accounts permit credit in expense account and amounts retained in current liability. Now, what do I mean by saying accounts permit credit in expense? Credit in expense accounts. I put this very literally, but look at a normal, simple trading account. Please imagine or visualize a trading account. You have opening stock, you have inward supply or purchases, then you have wages, cartage, coolie, etc., which are direct expenses, gross profit. On the other side, you have outward supplies or sales. Then you have any other direct income, say labor charges, and after that you have closing stock. Right? This is the transaction inventory. This is the transaction insofar as reporting for trading account is concerned. Now, accounts permit credit in expense. Now, what is credit in expense? I can say inward supplies are purchases less returns. One way of showing it. Inward supply can be shown as purchase less returns, or this purchase returns or inward supply returns. I can show it as outward supply. I can show it as outward supply, or simply say on the credit side in the trading account, purchase returns are outward supply returns. Now, how does this impact? How does this impact the input tax credit? Carefully think through. I gave you an example of returns. Therefore, you are saying, what will happen? Nothing will happen here. I pay output tax there. If I don't show it as purchase returns, if I show it as purchase returns, I will be reversing input tax credit. If I show it as purchase returns on the credit side by raising an invoice and not reflecting it as output tax credit, I will be paying output tax. Nothing changes. Life remains the same. Now, I will tweak this example a little. Look at this example. Consider discount. Purchase less discount. Then I have a valuation problem. The moment I reflect credit in expense account, the alarm bells must ring in your mind and bring in section 15, subsection 3. The moment I show section 15, subsection 3, life will be quite miserable. Sir, what valuation you are talking of in discount, sir? There is no valuation that is required for discount. Is something which you will immediately say. But what I am trying to tell you, well, there will be no issues relating to discount that can come up. You have to fulfill the conditions relating to discount in section 15. This is where I have a problem. This is where I have a problem. Now, several entities camouflage incentives as discount, price protection as discount, replacements as discount, product support as discount, and in the normal course, business promotion as also discount. In each of these cases, you will have to be extremely careful to figure out, because the government has withdrawn the secondary discount circular. Please be careful. 125/2017 has been withdrawn. So the government is aware that the business entities are camouflaging all these taxable transactions as discount. Please be careful. Please be careful. Incentives are taxable at the rate of 18%. Whereas the product may be taxable at the rate of 5% or 12%. It may be. But if there is an incentive element in it, it will be taxable at the rate of 18% as a service. You cannot camouflage that as a discount. Wherever the products are susceptible to market changes, for example, consumer goods, iPhones, televisions, computers, laptops, I don't know, call it by whatever name, but which are susceptible to model changes and time limits, it has a specified shelf life. Now, these have what is called as price support, which the company gives. Now, what the company will tell you, if let us say Abhishek is having 100 Dell laptops with him, not able to sell, but Dell has introduced a new model, they will tell you, dispose of this old laptop with 5,000 rupees as discount. I will give you a credit note for 5,000. Now, this 5,000 is not a discount. This 5,000 is not a discount. In fact, turnover doubles in this case. What will happen? While this 5,000 doesn't become a discount, the credit note will show that credit is reversed. Actually, it is incorrect. It is price protection. It's price protection or price support, and it doesn't become a discount. The government is aware of these transactions. Be careful to reverse input tax credit. These are issues that will come up when you look at input tax credit. So this is credit in expense account and amounts retained in current liability. Amount retained in current liability. Now look at the current liability in the balance sheet, which means current liabilities are in respect of expenses to be paid in a short while within a reasonable time frame, or where you have received money but goods or services are yet to be supplied. Now these are typically in respect of annual maintenance contract companies, where revenue is recognized based on the period for which service has already been rendered. Revenue is recognized based on the period for which service has already been rendered. So we will have to be extremely careful in respect of these cases. Now, in respect of these cases, what happens is, typically you will have to be careful of the matching concept. Well, in respect of an AMC, if an entity is doing, if an entity's business is only carrying out of AMC, typically it would have raised an invoice in the month in which its contract is entered into, received the full amount of annual maintenance contract in advance, paid the appropriate taxes at whatever rate, 12, 18, 28, whatever rate, they would have paid it, uploaded that in GSTR1, credit will come and sit. Credit will come and sit in GSTR2A of the recipient. Typically, can the recipient claim input tax credit in such cases? Be careful. There are 4 conditions that you will have to fulfill. The 4 conditions that you will have to fulfill is receipt of invoice. You have the invoice because the AMC provider has already issued an invoice. Second one is uploading the invoice. That is uploading GSTR1 or filing a return, which he has done, and payment of taxes, which the supplier has done. The only difficulty is there is no receipt of service. If you don't receive the goods or don't receive the service, typically you are not entitled to input tax credit. You are entitled to input tax credit only in the month in which you receive the goods or receive the service. Please read section 16 subsection 1 very carefully. It talks of entitlement on fulfillment of conditions. You are entitled, but your eligibility comes only on receipt of goods or receipt of services. So typically the government is aware of these transactions. Importantly, in case of large companies, they have large annual maintenance contracts. Input tax credit can become a major issue. It can become a major issue in respect of these entities. Now, you need to look at turnovers validation for the purpose of input tax credit. Now, what is this validation of turnovers? The validation of turnovers will be only in respect of output tax is what you will think. The corresponding diametrically opposite entry is in respect of input tax by the recipient. Treatment in earlier laws is no estoppel in a goods and service tax regime. Treatment under earlier laws, VAT, sales tax, whatever law, is no estoppel. Barter was not liable to tax. I have come across situations where barter and exchange are very loosely understood and loosely used. Both are completely different concepts under law. Both are completely different concepts insofar as GST is concerned. In the case of a barter, it is one for the other and there is no value. A typical barter case can be, I can tell my secretary who's there, Murli, to say, here is the watch that I will give you. Please give the coat that you are wearing. It is a typical case of barter where there is no value attached to any of these transactions. Whereas in the case of an exchange, there will be a value attached to a particular transaction where a retailer can say, bring your old washing machine, I will give you a 1,500 rupee discount on a new television set or washing machine or mixie or grinder or call it by whatever name. The moment a value is attached, there is an exchange and it doesn't become a barter. Valuation in barter becomes a serious challenge. It becomes a serious challenge. Therefore, while barter is a supply transaction liable to tax under the goods and service tax law, availment of input tax credit in case of a barter becomes extremely difficult. While in respect of my watch, I will probably write off the value that is there in the books of my account. So also, Abhishek will write off the value that is available in his balance sheet in respect of his coat that is there, which probably will be the book value. But valuation principles don't take care of this transaction. So typically, you will have to invoke valuation principles in respect of barter transaction to put a value, file your return, pay your tax. To the extent of tax, you will have a cash flow issue. While I can value my watch at, let us say, 2,000 rupees, typically Abhishek can value his coat at 5,000 rupees. There is an input tax issue here because the government will tell you in the case of a barter transaction, the tax paid by one person, it should be exactly similar to the tax paid by the other person because there is no value attached to this transaction. Both valuations must be the same. Therefore, if Abhishek Murli's assessing officer values his coat at 12, my watch should be valued at 12. These are issues that they are looking at. Why am I talking of these issues? I'm talking of these issues because typically there are barter transactions taking place in large entities. One such example that I can give you is Jindal Steels, where typically Corex gas is bartered for receipt of oxygen or for receipt of cement or for receipt of electricity Corex gas is a byproduct of Jindal Steels. This Corex gas is given by Jindal to any other entity and they take in exchange oxygen, cement, electricity or whatever service they want. Valuation becomes a key issue. So don't get confused between exchange and barter. Barter was not liable under old laws, but GST has traveled far beyond these laws. Classification can also lead to credit issues. classification can lead to credit issues. Classification is now HSN based. Mentally be clear that from 1st April, your HSN classification has become mandatory of 4 or 8 digits has become mandatory. Shortly, all transactions that you execute will become HSN compliant, will be made to be HSN compliant transactions. In all my lectures, I take only 2 examples to figure out what is the problem with HSN. All of us know that classification is one of the biggest issues that every chartered accountant in practice of indirect taxes will face. Now take this HSN related issue. Let me give you one example. Look at this commodity called bearing, B-E-A-R-I-N-G. Bearing is used in automobile, bearing is used in fan, bearing is used in mixie, bearing is used in a grinder, bearing is used in machinery, bearing is used in bicycle, bearing is used in aircraft. I don't know where all bearings are used. Anything that moves will have a bearing. Anything that moves will have a bearing. Bearing is also used in fans. Now, anything that moves, if it it's called a bearing. In simple terms, you may turn around and say that bearing is liable to tax at the rate applicable or classified for the purpose of machinery, which will be 18%. Consider this case where a unit manufactures bearing only for automobiles, for use in automobiles. What will be the rate of tax in respect of that case? It may be very easy for you to say that charge 28% and be done with it. Tomorrow, if I am going to buy, let us say, fan manufacturer, Usha fan manufacturer, or Havells fan manufacturer purchases bearings, he is not going to pay you 28%. He will tell you my rate of tax is 18% for bearing. You want to supply, supply. Don't want to supply, keep moving. Somebody else will supply. So you will have to be very, very careful in respect of HSNs relating to these commodities. There are several commodities which is going to have this HSN related issues. You have to be extremely careful, because simply because the supplier has charged you 28%, don't think input tax credit will be available. No, input tax credit will not be available. Simply because somebody has charged 28%, I will allow input tax credit only at the rate applicable to the product. Rest of it I will not allow. You may have fulfilled the conditions, but input tax credit is at the rate applicable. Rest of it, I will say keep on fighting. Let us see at what point in time this fight ends. So you have to be very careful in respect of HSN related transactions. Now, leasing is a service and valuation is based on open market value. Please be careful in respect of all leasing transactions that there will be a valuation mechanism that you will go through. The valuation mechanism is in respect of output and not in respect of input. If output differs, be very careful. Corresponding input tax credit will be denied. It will be denied. So don't think that leasing is not subject to valuation. Every transaction of leasing will be a subject matter of valuation, because transaction price cannot be ascertained in a leasing transaction. Goods are supplied, the payment is deferred over 12, 24, 36 months. It will go through a valuation mechanism. Therefore, my statement is GST gives new treatment to old transactions. Now, there is some confusion when we talk of leasing. I have always said we have to be very clear in accounting. If our accounting is clear, half our headache will be over. If our accounting is not clear and correct, the headache commences there. In my 30 years of practice, or 31 years of practice, or 32 years of practice, I have not been able to put my finger and figure out what is meant by lease, renting, hiring, etc. Now, what is renting? What is hiring? What is leasing? You can sit there, turn around and tell me, sir, what is wrong with you, sir? Lease means transfer of right to use goods. There will be a transfer of possession. If there is a transfer of possession, there is a lease, there is no renting or no hiring, then what is renting and what is hiring? You say you rent a house. You don't say you hire a house. You hire an auto rickshaw, correct? But you rent a cab. So what is the difference between renting and hiring? Please go back, look at the transaction, because there is a rate problem in respect of these transactions. It is 12, 5 without input, 12 with input, in some cases 18, in some cases 28. You have to be very, very careful in respect of these transactions. We have renting, leasing, and hiring. Please understand that, because it has an implication on input tax credit. I have purposely brought in this slide, although my topic is input tax credit. The reason for bringing this is to bring in the responsibility of who has to do what. When the annual return, the author is the assessee or the author is the dealer. A reconciliation statement or your 9C, the author is the auditor or the chartered accountant. Yes, to explain. Now there are a lot of issues that have come. You will say GSTR 99C has been done away with, but anyway, past issues will continue to exist. I think the last bullet point becomes absolutely important in this case. The last bullet point is, when there are two possible views, please disclose the view so that you don't get into 74 of non-disclosure, willful misstatement, collusion, fraud, avoidance, etc. Please get away from that. Therefore, it becomes very important for you to disclose before you move. Now, once again, while I'm talking of turnover, I'm correspondingly talking of input tax credit also. The issue that will arise in respect of input tax credit. I'm saying report all turnover, including exempt turnover, non-GST turnover, and no supply transactions, because its impact will be on input tax credit. Now, take for example a retail store. A retail store, it will sell fresh fruits and vegetables, it will sell meat, it will sell frozen meat, it will sell frozen meat, it will sell chilled meat, CHILLED, it will sell chilled meat, it will sell taxable goods, it may also sell services, supply services. Now, all of this are required to be disclosed for the purpose of reversal of input tax credit. You cannot say that, sir, I sell vegetables and fruits, which is the largest amount of turnover, or anyway exempt. Therefore, I have not disclosed it in my 3B. No, because reversal of input tax credit is the issue. So, if I am looking at a retail trade, I must see some input tax reversal. If I don't see input tax reversal in a retail trade return, there is a problem. There is a problem. You have to be extremely careful in taking these transactions to its logical end. So if there is no reversal, there will be a difficulty. Therefore, input tax credit is an issue. It is an issue. So you have to disclose all turnover, including exempt turnover. In fact, I have come across situations where export is declared as exempt turnover. This is a bigger problem, because the moment you disclose it as exempt turnover, he will tell you reverse input tax credit. These are actually zero rated suppliers. Exports and SEZ suppliers are zero rated suppliers and don't become exempt suppliers. You will have to be very careful. Credits in expenditure account, like incentives, please be very careful. This is what I was talking to you earlier. We have already handled this. Notice pay credited to salaries. All this is settled by Madras High Court. I will not spend time, because corresponding input tax credit can be availed. If you claim exemption, input tax credit has to be reversed on a pro rata basis. On a pro rata basis, advance in current liability account, like reimbursements, pure agency transactions. Be careful in respect of pure agency transactions, because output tax is not payable. Input tax credit also cannot be availed. Importantly, common credits cannot be availed. Those of you who are handling entities like warehouses, warehousing corporations, state warehousing corporations, Food Corporation of India. In all of these cases, you have substantive pure agency transactions, substantive pure agency. Corresponding input tax credit, you will have to reverse, whether it is based on the pure agency turnover or whether it is going to be based on transaction to transaction. I will not be able to sit here and tell you that it has an input tax credit issue. I must see a reversal. If I don't see a reversal, be mentally clear that it is going to be an audit issue. Turnover includes, next. Look at these transactions. Wherever there is money measurement, you will find these transactions in the books of account. Wherever there is no money measurement, you will not find these transactions in books of account. Now, once again, I go back to my transaction relating to exchange. Bring your old TV for a new TV. Hand on heart, how many of us have valued this old TV or correspondingly reversed input tax credit of new TV? Either I pay tax on output or I reverse input tax credit. So it is an input tax credit issue. You cannot claim full input tax credit because you have not reflected the output correctly. And these old junk washing machines, junk, I don't know, or whatever, gas stoves or fans or whatever, it may not be valuable at all. It may be 0, it may be 100 rupees, it may be 500 rupees. If there is a value, corresponding input tax reversal is required or output tax payment is required. These don't get reflected in the financial statements. That is where I am coming from. If they get reflected in the financial statements, I have absolutely no difficulty. 99.9% of the exchange cases, I don't find these transactions reflected in the financial statements. Therefore, I am saying you will have a input tax credit issue. I will tell you 5% of the input tax credit is attributable to the transactions relating to exchange, and therefore it is fair to deny 5% of the input tax credit. Alternatively, I tell you, pay tax on output in respect of these transactions. I will be all right. Now, look at the next point. Gift given to customers for no extra consideration. I am very confused of what is a gift, because if I am able to tackle output, I will be able to tackle my input. Now I get very confused between gift, sample, business promotion. Gift, sample, business promotion, advertisement. Now consider a case where, let us say in Chennai Mall, in a mall in Chennai, if Geeta madam were to enter, they will tell you, please have this glass of juice. What is that? Is it a sample? Is it business promotion, which means it is in the course or furtherance of business? Is it advertisement, or is it a gift? Now, why is it a gift? Because the moment you enter that shop, he will give you one biscuit or he will give you a small juice bottle. What is that? Is it gift? Is it sample? Is it advertisement? Business promotion? Take your call. Take your call. If it is sample, if it is gift, there is input tax reversal. There is a credit issue. Please be careful. There is an input tax credit issue. Be very, very careful. Otherwise, output tax will become payable. No transaction can be kept outside the annual return. No transaction, including securities and other capital flows. Why I have taken this transaction is there is an input tax credit issue in respect of large companies. Take companies like Infosys, take companies like TCS, Accenture, Cognizant, etc., where they have large amount of fixed deposits. These fixed deposits accrue interests. They get interest. Corresponding input tax credit needs to be reversed. Therefore, there is an input tax credit issue. Please read explanation to Rule 45, Section 40, Rule 45. You will be able to figure out how to go through these transactions in respect of reversals. Next, turnover reversal actually means credit issue, input tax credit issue. I always have a problem in respect of Section 34. Is it a section which restricts credit, or is it a section which levies tax? Is something which I have not been able to figure out. But reversal is restricted only to 4 classes of transactions. It is here. There is no difficulty at all. If you don't fit into these 4 transactions, please reverse your input tax credit. I am telling you very carefully. Please read this with some responsibility. If your transaction of reversal does not fit into these 4 transactions, corresponding input tax credit needs to be reversed. There is no question of output tax payment. Input tax credit ought to be reversed. Now look at the next one. Discounts are required to be tested for compliance. Now here there is a credit issue. Input tax credit issue here. Now discounts in bill. When it is there in bill, that means it is stated on the face of the bill, you can always adjust your input tax credit or set off your input tax credit. Discounts that are off bill can reduce only if conditions of 15(3)(b) are satisfied. Therefore, I told you, be careful to figure out whether it is price protection, incentive, discount, business promotion, or something else camouflaged as discount. Be very, very careful. Discount which meets the condition of 15(3) alone, credit can be claimed. In all other cases, you have to have reversal of input tax credit. Therefore, I am saying if discount does not mirror the accounting treatment, input tax credit is required to be reversed. Therefore, I am saying input tax credit is required to be reversed if the recipient does not mirror your entry. That means if you are showing purchases less discount, I want the supplier to show sales less discount. He cannot take it to P&L account. He cannot show gross up sales and say this is business promotion or incentive or something else in P&L account. No, that is not possible. So it must mirror. Please be extremely careful when you reflect these transactions in the annual returns. Now, turnover doubling or reversal of input tax credit. I already gave you these examples of exchange and gave you the transactions. The 2 options, either reverse input tax credit or pay output tax on the exchange value. Choice is yours. If you pay output tax on exchange value, you pay at the rate applicable to the product. Rate applicable to the product. Alternatively, you can reverse pro rata input tax credit, which will be a basket of input tax credit that will be available to you. Please look at this very, very carefully. But these are transactions which are reflected, required to be reflected in the return. Otherwise, you will have input tax credit as an issue. If I am the commissioner, I will look for these retailers and issue notices. I have a bigger problem in respect of cashback given as returns. The cashback, for example, if Geeta madam were to go back to, let's say, a Sapna bookstall in Bangalore or perhaps a Chennai Central mall in Chennai, there is a cashback for every purchase she gets. What is that? Is it a discount? In my view, it is not a discount. It is not a discount. Therefore, you cannot avail the rebate or claim in respect of output tax payable. In fact, the output tax payable will increase to the extent of this cashback given, because the cashback voucher that is given to you is not set off against the money to be paid by Geeta madam against the transaction. It is not set off. It is in respect of a future transaction that we will have to be careful of. Therefore, in respect of these transactions, what we have to be very careful of is these cashback transactions, whether it is for future or it is in respect of current or in respect of any past transaction. Cashback transactions will definitely be a questionable transaction. In my view, pro rata input tax credit will get reversed. The others are simple. Please look at these transactions. Double benefits. I will not waste my time here. These envisage input tax credit reversals. Input tax credit reversals where you cannot claim input tax credit twice, like depreciation, input on input services, treatment of input on input services, etc. Now be very careful of timeliness of tax payment. Otherwise, it is as good as tax law where there is a credit issue. Liability belongs to the month. Liability belongs to the month. Please be careful. Liability belongs to the month. In simple terms, outward supply or sales is liable to tax in that particular month. Be careful. Tax is required to be paid. Otherwise, you need to pay interest. But credit is available only in the month in which you claim. Only in the month in which you claim. Therefore, I want chartered accountants to be extremely careful in respect of transactions where outward supply was not reported in the previous month but added back to the subsequent month because there is no revision of return possible and set off against tax of that particular month. Be careful. I will make you reverse your input tax credit. You cannot set off future credits against past liability. You have an ITC issue. Future credit cannot be set off against past liability. That means declare nil turnover this month because you know you are getting a purchase invoice next month. No, you cannot do it. You cannot do it. You have to be extremely careful. You have to be extremely careful and figure out how the future taxes cannot be set off against past transactions. Be very, very careful. Liability is to be settled with credit taken or cash. Any liability discovered means cash payment. You cannot set it through input tax credit, although the portal allows you to do it. That means if there is a past liability for 1718 or 1819, be very careful. Simply because input tax credit is available on the portal, you can't set it off. Past liability cannot be set off against future credits. Past liability has to be physically paid because in that particular year you did not have the credit balance and therefore you don't have the credit, therefore you are required to be paid. You can always argue with me saying, sir, that input tax credit for let's say July 2017 was carried to August 2017 was carried to 2018, etc. But I don't think the government will accept. Now these are things which the government is checking. Past transactions, future liabilities, be extremely careful. You are not going to get credit. This is what I have tried to explain here in timeliness of tax payment. Now, let us come to input tax credit. Now, the input tax credit is provisional. Input tax credit is provisional. Input tax credit cannot be taken or availed in the manner in which you please. The first point that we need to understand is whether credit is a right or credit is a benefit. You will have to be extremely careful whether credit is a right or whether credit is a benefit. Now let us look at this entire input tax credit. Different provisions use different words, phrases, etc. If you look at section 16, it will tell you you are entitled. If you look at some other section, it will tell you credit can be availed. If you look at 17, it will tell you input tax credit is not available. If you look at some other section like 18, it will say input tax credit is required to be reversed. So eligibility, ineligibility, eligible, ineligible, reverse, block, available, avail, claim, set off, reverse are some things which you will have to be extremely careful in respect of input tax credit. If you don't understand these concepts clearly, you are likely to make an error insofar as input tax credit is concerned. Now look at this transaction of input tax credit that we are talking of. Credit is a vested right. That is what every child accountant and every lawyer will tell you. But credit vests. Credit vests. It is a right that will vest in you only if you make a claim. If you don't make a claim, it doesn't vest in you. Simply because you have an invoice in your hand which is not accounted, it does not mean that you have a credit which vests in you. Simply because you have accounted it in books of accounts but not reflected it in the return, you are not entitled to input tax credit. That credit will vest as a right or a benefit only when you stake a claim in the return. So credit is a right or benefit. It vested right. It is a vested right after section 16 subsection 2 conditions are fulfilled. You have to fulfill all the 4 conditions Starting next month, I think you will have to fulfill the fifth condition also. Now I will tell you what are these four and what is the fifth condition. Four conditions are possession of invoice, receipt of goods or receipt of service, filing of return by the supplier, payment of tax by the supplier, and the new condition that I have brought in is uploading this transaction by the supplier so that it reflects in your 2A. Uploading this transaction by the supplier in GSTR 1 so that it applies in GSTR 2A. This is what we will have to be extremely careful. Therefore, this right rests only on claim. Practical as a taxpayer is required to answer. If you don't make the claim, there is no credit. Eligible credit is not available until it is taken. Now be careful. I am using the word eligible credit. I am not using the word credit entitled. You may be entitled. You may be entitled to credit, but that entitlement can be claimed or it becomes eligible only on future date. You are entitled to input tax credit on supply of goods by the supplier in the previous month, but you are eligible to take the credit only when you receive the goods. Eligible credit is not available until taken. So you have to take it in the return. Credit taken is provisional. Please be careful. Please read section 155 very carefully. Credit taken is provisional under 155. You will have to fulfill all the vesting conditions under 155 because the burden of proof is on the taxpayer to prove the eligibility and not the department. It is on the taxpayer and not on the department. Now, you look at the next slide, you will understand credit eligibility. Credit appearing in 2A is not final. Now you may argue with me saying, sir, 1 minute back you told me credit must appear in 2A. Now suddenly you are saying credit because it appears in 2A is not final. What are you talking? One of the conditions is it must appear in 2A. But for you to be eligible to take that credit, you have to fulfill all these 5 conditions. Possess invoice, receive goods or service, supplier to file return, supplier to pay tax, supplier to upload data in the portal in GSTR 1. Once these are uploaded, yes, then there is an entitlement. You are entitled, but you may not be eligible. 2A is only a record. Now, why I tell credit appearing in 2A is not final. Be very careful. The credit appearing in 2A may be ineligible credit, maybe blocked credit, maybe somebody else's credit which is coming and lying here simply because somebody has made an error in TIN number, an error in uploading the TIN number. Alternatively, it can be credit ineligible, it can be credit not available, it can be credit liable for reversal, it can be anything. Therefore, you have to be extremely careful about credit eligibility. That is why the next bullet point, GST imposes impossible conditions. It imposes impossible conditions. Now, these are matters which will have to be fought in the court because you can always turn around and say, sir, how do I know whether that fellow has paid his tax or not? Fully understand. I fully understand your problem, but we really cannot help. So GST imposes impossible conditions. But the GST officer is not empowered to allow the relief based on your difficulty. He cannot give. He will say, fulfill your conditions, take your credit. Now here I've given you an example of March 2019. For March 2020, credit is already gone. So if you have not accounted the invoice or taken it before September, that credit is lost forever. That credit, you are not going to be eligible. You are not going to get that credit at all. Now what we will do, it is 6:40 now. I will take this last slide and with the permission of the organizers, break for 5 to 8 minutes and then reschedule and reconvene. So now let's look at credit ineligibility. So this will be the last slide before we have a small break for 5 to 8 minutes. Ineligible credits are listed in section 17.5. Please be careful. On section 17 subsection 5 credits, credit is not available. It is ineligible at the threshold. It is ineligible at the threshold. So you can't claim the credit and then reverse it. it is blocked before even you can take the credit. For example, credit on motor car purchase, it will be reflected in 2A, but the credit is blocked at the threshold. The credit will appear in 2A, but you cannot take that credit. You will have to reverse it in the portal. You will have to reverse it. And the credit cannot enter the credit stream. That means it cannot come into the return. It says credit not available. That means it cannot even come to 3. If it comes to 3, then you have to reverse. But if it should not come to 3, it is blocked at the threshold. Credit is blocked even though inward supply is used in business. For example, the car can be used for business, but credit unfortunately is not available. If you take the credit, then it will be reversal with interest, and that interest will be at 24%, and that interest will not be at 18%. Proportionate reversals to be done. Proportionate reversals to be done monthly. Anything where there is a proportionate reversal, like I gave you the example, security services in case of hotel where alcohol is served, security services, rental services in respect of hotels where alcohol is served. Now, these are monthly reversals that you will have to do. You cannot do a reversal at the end of the year. Every month you have to true up and true down and continuously keep reversing the input tax credit under 41 and 42. Now, the challenge is to identify this common credit. The challenge is not in knowing that you have to reverse, but the challenge is to identify the common credits. How do you identify the common credit in respect of a bar and restaurant? Should it be based on table? Should it be based on square feet? Should it be based on, let us say, only one bar? Because any person can go sit in a bar without drinking, he can eat and get out. In that case, input tax credit may be available. He can drink a juice with his friend. His friend may have a glass of wine. Doesn't matter. But therefore, identifying this input tax credit becomes a challenge. Importantly, let us see how are you going to identify, assuming that this, in respect of this hotel, it is a rental payment is also there. Pro rata input tax credit in respect of rental payment. How do you ascertain? It is based on the bar area, or it is based on footfall, or is based on turnover, or is it based on value of liquor sold, or is it based on value of food sold, or is it based on the accommodation services that the hotel supplies? Extremely difficult, and it is challenging to identify common credits. Direct credits, there is no difficulty. Identifying common credits, whether it is in or out, whether eligible or not eligible, data-based bifurcation is required to be done. It's easy for me to tell you this, but it is extremely difficult for you to handle this data bifurcation for the purpose of input tax credit. What we will do is, the time now is 6:45. I think one of the organizers can take over and tell us how long we should break before we get back to this slide. Yes.
Yeah. Sir, 10 minutes, sir. Now it is 6:45. Can we reassemble as 7 o'clock or 6:55, sir?
6:55. I will have 2 minutes to do. 10 minutes, Geeta madam, if with your permission.
Yes, sir. So we will reassemble at 6:55.
Absolutely.
Yeah. Thank you, sir. Thank
you.
Sir, we'll leave it as such. Yeah.
Members, let us stay tuned, and we will be back within 10 minutes. So just we are switching off our cameras just. Venkataramani sir?
Yes,
Yes, sir. You can start, sir.
I can start. Right. Thank you.
Thank you.
Just setting my PPT 1 second. Yes, welcome back. We had a very brief break, but very interesting issues relating to provisional credit that we are talking of. Credit is taken provisionally. Why am I saying the credit that you take in your 3B is provisional? This is because of section 155. Because it says the burden of proof lies on the assessee to say that the credit he is entitled to. So you have to answer 155. What is answering 155? Please read 155 if you have it in front of you. 155 will tell you the burden of proof in respect of the claimant. It is in respect of the claimant. Therefore, credit has to answer all the 4 conditions plus 5 conditions now. Somebody has already asked me a question. I'm seeing it in the question box here or chat box here. The difference between 2A and 2B. I will definitely answer this at the end of the day, the end of the session. But credit is provisional. Credit is answerable to all compliance conditions. If credit doesn't answer all the conditions, then credit taken is liable for reversal. Now, be careful. If you look at the first bullet point here, I have also said that it must answer the condition relating to end use. Now, what is this condition relating to end use? Now, let us look at a case where our treasurer, Geeta, is running a distributor company. She is running a company or a firm which distributes consumer goods, say biscuits, for example. She is the distributor of a biscuit entity. Now, what happens here? She will continuously keep taking input tax credit in respect of all the biscuits that are supplied by the supplier, and she will keep paying output tax on the output. But what she can do is she can also use a few biscuit packs to be given as samples, few biscuit packets as gift hampers to somebody else. The moment the end use is changed in respect of samples from in the course or furtherance of business to samples, then the credit gets blocked. You have to reverse the input tax credit in respect of such transactions. Be extremely careful, but you will not be entitled to input tax credit if you don't answer the end use condition. Therefore, I have said end use deviation attracts reversal. Intended to be used, you have to be very careful. You can avail credit if you intend to use in the course or furtherance of business, but that intention to use is liable for reversal if it is finally not used. So samples, gift hampers, etc. are liable for reversal of input tax credit. You have to be extremely careful to reverse the input tax credit in respect of such transactions where the intention to use has not been met with or the intention to use is deviated. Interland supplies are subject to valuation because they become related party transactions. Therefore, the credit taken is provisional. Now look at this issue. There are several child accountants who have called me and said in respect of inter-branch transfers or stock transfers, you can put any value and stock transfer because the recipient is entitled to input tax credit. The recipient is entitled to input tax credit. This is what chartered accountants have been calling me and telling me. I have always told them, simply because the recipient is entitled to input tax credit and these are inter-branch transactions does not mean that you can put on 500 rupees and send the goods outward. Please be careful. Valuation principles, the moment it applies, you will have to start from rule 27, go up to rule 30, and in that order, you will have to apply the rules. The first rule, rule 27, directly says that you will have to apply the open market value. And in that order, if that cannot be determined, then go to 27B. If 27, yes, B. If 27B cannot be applied, C cannot be applied, D. Then you go to 28, etc. 28A, very clear that the transfer price shall be open market value of such supplier, provided that where goods are intended for supply by the recipient, the value shall, the option of the supplier, be an amount equivalent to 90% of the price charge. It cannot be lower. So don't put one ad hoc value for the purpose of movement of goods on account of interbranch transfers or stock transfers. I will reverse the input tax credit in the supplier's hands and probably charge tax in the recipient's hands. It will be a double whammy. Please be very careful. One is required to maintain detailed information of credit taken. Be careful. Credit taken is different from credit availed, is different from credit availed, claimed. So this is called credit taken. Taken is different. I don't have the time. Credit belongs to the month in which credit is taken. Otherwise, input tax credit is lost. This is an issue. Delay in taking credits does not shift the credit back in time. That means you cannot say, sir, I had this inward supply invoice which belonged to October. I have not taken the credit. I am taking the credit in February. I am taking the credit in February. Therefore, allow the input tax credit for the purpose of October if there is a past liability. No. Delay in taking the credit does not shift the credit back in time. It does not shift. Credit will stay in the month where it is taken. Credit will stay in the month where it is taken. It is not going to go back in time. You have to use the credit as and how it is taken. That means if the credit relating to October is taken in February, you use it in February, no difficulty. But you can't use it for October because you have not fulfilled the conditions relating to availment of input tax credit of taking the credit in the return. Delaying taking credit, therefore, will not shift the liability. I mean, will not shift the credit back to the old month. Invoice of previous year taken in current year will remain in current year. That means if March credit is taken in July, credit will remain in current year. You will have to reconcile your financial statements vis-a-vis your returns. There is no other way you can change it. Be very careful. When the supplier uploads GSTR 1, credit will go and sit in that month. Reconciliation is required to be done monthly. I will tell you what 2A and 2B is and its implication sometime later. Credit taken in current year cannot be utilized in previous year. Credit taken in current year cannot be utilized in previous year. There is a bar on suo motu adjustment of excess tax paid. You cannot adjust excess tax just like that. Excess tax paid is to be claimed as refund under section 54. Please read section 54 carefully. If you have paid excess tax of, let us say, 100 lakhs, you cannot leave it there and set it off. You have to apply for refund and take that refund immediately under section 54. So you cannot suo motu adjust. You cannot suo motu adjust. You cannot say, I have money today, I will pay 10 lakhs and leave it there. No, you cannot get it because tomorrow you will ask for interest. I will not pay you interest. Therefore, suo motu adjustment of excess taxes is not possible. You will have to take a refund under section 54. That is how the law works. Now, input tax credit there will be correction required in input tax credit at some points in time. Now, what is this correction that is required in input tax credit? What is this correction that we are talking of in input tax credit? There is a shortfall in payment of tax in tax payments. If there is a shortfall in tax payment, then tax is to be paid in cash only. Cash is required to be paid. You cannot adjust the credit that will be available through DRC 03. If there is a shortfall in tax payments, you have to pay in cash only. Credit cannot sitting there in the portal, cannot be used. Now let me give you an example. Now let us say, for example, you are a subject matter of audit for 17-18 and 18-19. And at the time of audit, you accept for certain demands of the department. You accept to pay tax on certain transactions. You don't want to litigate. You just want to accept it, be done. You don't even want a 73 notice. Pre-audit verification report or statement comes to you. You want to pay off this, let's say 1 or 2 lakhs and be done with it and move on in life. Then you cannot adjust the input tax credit that is lying in the portal by effecting through it, by making payment through DRC 03. No. You have to pay the tax in cash. So shortfall in tax payment is only physical payment. There is no adjustment through DRC 03. You cannot adjust it. Interest on net tax is still not notified, is what I had written at the time PPT came. Now it is notified. It is on net tax payable. I have not corrected this because budget provisions came in only a day before. So it is notified. All retrospective amendments have now come in so far as interest on net tax is concerned. No credit if reverse charge mechanism dues are paid in 17-18. Challan. There is no credit. Now, let's say, for example, you are required to pay tax under reverse charge in respect of certain transactions for 17-18 or 18-19. If you pay it under 17-18, 18-19 challan now, and say I will take the input tax credit, I am afraid you are not entitled to input tax credit. Reverse charge mechanism liability paid in 19-20 is not eligible as input tax credit. Now, 2 reasons for this. I want everybody to look at Rule 31, or is it Section 31? Section 31, if I'm right, because that says you have to raise a sales invoice. You will have to raise a sales invoice. That sales invoice is required to be raised on the date of receipt of goods or services or both. It is Section 31, subsection 3, clause F. It says it is required to raise an invoice on the date of receipt of goods or services. So you can't take input tax credit without raising an invoice. You can't raise that invoice today. If you had raised that invoice then, you would have probably uploaded that in your GST or 3B. Because you have not raised an invoice, you can't do it now. Reverse charge mechanism dues paid in 19-20 challan creditable? No, in my view. For 19-20, if you pay in 19-20, you can claim input tax credit. But for 18-19 or 17-18, if you prepare the challan in 19-20, I'm afraid you will not be in a position to get input tax credit. Now, some of these issues, I have a very, very big problem. People think that everything should reconcile. I have a problem if everything reconciles. If your 2A matches with 1, matches with 3B, it matches with your financial statements, it matches, let us say, with your annual return, it matches with your reconciliation statement in 9C, I have a problem. Should not match, because if it matches, there is a problem. That means you are accounting on cash basis. It should not, because as the examples that I've been giving, supplier in Gujarat dispatches goods on 28, goods received in April, how can you claim the input tax credit? You cannot claim the input tax credit. So when I do a reconciliation for the month of, let's say, June, when this transaction has taken place, it should not reconcile. If it reconciles, I have a problem. Importantly, 2A should not reconcile with 3B. If 2A reconciles with 3B, I have a problem. Unless the transactions are so minimal that you only 3, 4, 5, 10, 20 transactions, and those 20 transactions are accounted on a month-on-month basis, I have no difficulty. If you are a going concern and you are accounting on a continuous basis, then it should not reconcile. There has to be a difference in reconciliation, and that difference in reconciliation should be explained through the reconciliation statement in 9C or in the financial statements through disclosures by way of a note to notes to accounts, then I am fine. Otherwise, I have a problem. Unless, as I said, the business is so small or the transactions are so few that you are able to reconcile everything on a month-on-month basis. Unreconciled items are desirable and they are inherent. Unreconciled items are desirable. Now take the cases of small entities. You account on concept of accrual. Therefore, it's simple thing. Annual maintenance contract. To the extent it is now prepaid, you accrue it. So how can you take credit when you have accrued it? You cannot take credit because you have not received goods, you have not received service. Therefore, you cannot, once you accrue, credit cannot be availed. Similarly, in respect of current liabilities, somebody else cannot take that credit. Therefore, unreconciled items are desirable. Importantly, pay attention to notes to accounts of chartered accountants. It reveals a lot of information. Just as I said earlier, revenue is recognized on dispatch of goods. Revenue is recognized on appropriation of goods. Revenue is recognized on raising of invoices. In all of these cases, it will be extremely easy for you in respect of goods, but in respect of services, it will be extremely difficult. Now consider this example of chartered accountants itself, which I will want to raise. You have signed your audit report, let us say, on 31st of December. Just an example. You have signed your audit report on 31st of December, uploaded all your income tax. Service is complete. You are required to raise your invoice on date of completion of service. If you are going to say, no, this client will not pay me fees, I will raise an invoice only when he is going to give me a check. Very unfortunate. You cannot do that. You raise an invoice now and pay the tax also accordingly. Similarly, credit for him also will not be available. The reverse is also true. Provisions are made by the SSC in respect of audit fees. Unfortunately, we don't issue an invoice in respect of the provisions made. Because you will turn around and tell me, I can't receive the audit fees in advance until I sign. It will become a big problem. It will become a liability. But look at the headache in GST. He will deduct tax. But to that extent, credit is not available for anyone because you have not issued an invoice. Reconciliation becomes a headache. That is why I said unreconciled items are desirable and they are inherent in any business due to variance in accounting versus GST treatment. Because of variation in accounting versus GST treatment. GSTR 9 is a window. GSTR 9 is a window into the business of the taxpayer. While GSTR 9 is a window into the taxpayer, all these adjustments relating to supplies made can be reflected in GSTR 9. There is absolutely no difficulty at all. 9C checks if everything is explained. GSTR 9C will only check if everything is explained. Now, the government has now done away or abandoned the concept of certification or attestation of 9C or what we colloquially call as audit. So now what will happen, sir? Audit is gone. Is the issue. Nothing will happen. They had a self-certification that has been bought in. The same 9C, instead of a chartered accountant signing, will be self-certified by the SSC. There is no requirement of a chartered accountant to sign. That is exactly what they have done. We'll discuss about this audit report if time permits at the end of the session. Therefore, GSTR 9C checks if everything is explained. That is all. All these errors, all these reconciliations, all these unreconciled items, variations, the issues that we have taught should be explained. If it is not explained, then we have a problem. Now, we need to understand the newness of this law. If we don't understand that this law has got inherent problems and this law has also got inherent difficulties in administering, then we have extremely difficult position to get into and to explain that to the government. That is not going to be possible at all. Now let me take you through the second set of slides that I have here. I'll take you through the second set of slides where you will be in a position to see. Are you able to see my screens, please?
Yes, sir. Yes. You can put it in
This new one?
slideshow.
A slideshow. I have to put it in slideshow. I'll put it in slideshow. 1 minute, I'm just trying to put it in slideshow. Is it not getting into slideshow still?
Not yet, sir. F5
Not
button.
yet. F5, yeah?
Yeah, now it's in slideshow. Yeah.
Now it is in slideshow.
Yeah.
Yes. Now what I'm looking at here, is input tax denial versus input tax restriction. Now don't worry about the number of slides that are here. Substantive number of these slides are only examples where I've given you illustrations of how you will have to reverse or avail input tax credit. Now there is a subtle distinction between denial of input tax credit and restriction of input tax credit, which we will have to understand. Now if you don't understand this, people will tell you colloquially input tax is denied. If I'm going to tell you deny entry to Geeta madam, that means I'm telling you don't allow her to enter the compound wall. She has to come to the road and move away from there. That is denial. Now what is restriction? I will allow her inside the compound wall, but I will not allow Geeta madam to come into the room. That is restriction. I will restrict Geeta madam from attending this conference. I will restrict, but she can come and sit in the lobby. Now, denial and restriction are two different things. If input tax credit is denied, then we will have to be extremely careful to say that it cannot enter GSTR 3B. It cannot enter GSTR 3B. It can enter 3B if there is a restriction alone that is possible. So be careful of what is denial and what is restriction. Now these are input means capital goods, etc. We will skip all this because these are the basic rules. I don't want to get into it. We have passed all that. Now here is section 16 subsection 1 where I want to spend a couple of minutes on this. Please read this very, very carefully. This is the definition provision. I'm sorry. This is the relevant section. See how this section reads. Spend a couple of minutes on how it reads. It says, every registered person shall, subject to such conditions and restrictions, be entitled to take credit of input tax. This talks of only entitlement. It doesn't talk of eligibility. It doesn't talk of eligibility. It doesn't talk of claim. It doesn't talk of availment. Now, what is the difference between entitled, avail, claim, eligible? Now, let's look at this. Geeta madam is entitled to TADA when she goes for institute affairs. She's entitled. She's entitled. Now, how much can she avail? Institute will tell you two things. 25,000 rupees per day or up to 40,000 on production of vouchers. While she is entitled to claim input tax credit, she can avail 25 or 40. She is entitled to whatever, but she can avail 25,000 or 40,000 depending on whether she wants to go with vouchers or does not want to go without vouchers. Choice is hers. She can claim either 25 or 40, not both. She cannot say, I will claim 40 and reverse 15. No, she cannot do that. She can avail either 25 or 40, then she can claim only that much. She is eligible. What is the eligibility? There will be a threshold. There is a president of ICAI can travel in business class, but Geeta madam can travel only in, for example, I don't know, whatever, whichever class, economy class. That is all they may say. So eligibility, availment, claim, entitlement, all are completely different. On supply of goods or supply of services of both, which are used or intended to be used in the course or furtherance of business. So it must be in the course or furtherance of business. That in the course or furtherance of business is the ones which I have discussed with all of these examples to you. Now this credit under section 16 subsection 1 is a subject matter of fulfillment of conditions which are stipulated in 155. 155 relates to burden of proof. In order to be entitled, you have to fulfill the conditions. Once you fulfill the conditions, you are entitled to input tax credit. Now look at this here. Somebody had asked me the difference between this 2A and 2B that is coming here. If you are still here, look at this slide. Herein comes the explanation. You are entitled to credit if you have fulfilled these 4 conditions. This is what I am telling you right from the beginning. That 155 stipulates conditions, or 155 is provisional credit. 16 subsection 2 stipulates the conditions. Now they have added one more condition. Now what is this one more condition that we are talking of here? Please read this box which is here on the right hand side, which is there in this box. There it reads additional condition inserted to finance bill. Now it says input tax credit on invoice or debit notes can be availed only when the details are furnished by the supplier the statement of outward supplies. Supplier furnishing a statement of outward supplies is GSTR1. GSTR1. That means one more condition is imposed. Earlier this condition was not there. If these 4 conditions on the left hand side of your slide had been fulfilled, you can take input tax credit. Now the new condition that has come in Finance Bill 2021, it says that a supplier must upload in GSTR1. That means if he uploads in GSTR1, it will come and sit in your 2A. Only then you are entitled. Now if you look at this, that's at 10%, 5%, 25%, 20%, all of these conditions under 36. Now those conditions are further refined to give effect to it. He is now telling you only when details are furnished by the supplier the statement of outward supplies. That means supplier is required to upload it in GSTR1. It will come and sit in your 2A. Only then you are entitled to such input tax credit. And such details are communicated to the recipient. Communicated to the recipient means what? Please be careful. There are 2 conditions here. Both these conditions are to be read with this and. I am just taking my cursor to this and. You will be able to see this and here. Furnishing details in GSTR1 is one matter. Communicating it to the recipient is another matter. Now, why are they saying this? Now, let's say, for example, Geeta Madam is a supplier. She can continuously, on a real-time basis, go on uploading all her sales in GSTR1. It will keep coming and sitting. It will keep coming and sitting. Now, there will be one other person who will not upload on real-time basis, but will upload it before 10th of the subsequent month. No difficulty. It will come and sit. There will be few other people who will not upload it before 10th also, but they will upload it before 19th when they file their returns. When they file their returns. In such cases, what happens? There is a cutoff in 2A. The 2A cuts off on 10th of that month. That means if there is a supplier who has uploaded the outward supply details in GSTR1 on 15th of the subsequent month, the recipient cannot avail credit. That is the implication. Whoever has asked this question in the chat box, what is the difference between 2A and 2B? It will come and sit in 2B, but the auto population credit will be taken from 2B and it will not come from 2A. This is the difference. This is the difference. 2B credit alone will be permitted. 2A credit will not be allowed. So credit in 2B. Once the credit appears in 2B, then what you have to do is eligible, ineligible, not eligible. All of this you will have to figure out and take the input tax credit. Now, the next one is we are talking of eligibility of input tax credit in respect of goods sent on installment basis. Absolutely no difficulty at all. I don't think there is any difficulty. If you read my example, you will be in a position to handle this. Now, this is an input tax credit issue, which I want to speak for 1 or 2 minutes on this matter. The relevant provision under section 16, it says, recipient of goods, if you don't effect payment to the supplier within 180 days, then in terms of Rule 37, you will have to appropriate that tax as output tax liability, pay interest for the relevant period. You will have to pay. Now look at the difficulty here. There are certain large companies. They won't have track of this 180-day payment business. Let me give you an example of Infosys itself. Infosys takes credit only on payment. He doesn't take credit which appears into a, he doesn't take credit if he has invoice. If he pays, he will take credit. If he doesn't pay, he doesn't take credit. He has a control mechanism at the end of the year in March that all invoices relating to the previous year should be paid off within that period of September 30th, in which he will take input tax credit. Therefore, this 180-day credit, I have a challenge. Now consider the situation where my terms of supply itself is 240 days. My terms of supply for payment is 240 days. I am willing to give you 240-day credit. Now, most of these public sector entities, large companies, have got this credit mechanism going, which is upwards of 180 days. They will not invalidate, they will not take your credit, they will not effect your payment. They will pay and they will take credit. Therefore, in respect of these cases, I think this 180-day is a challenge. I think we have a good case to fight here, where the purchase order or the contract element exceeds this 180 days. What is the situation? I think we have a good case to fight there. I am of the view that this 180-day business is very loosely drafted. Although it was in service tax, it was loosely drafted. I think we have a good case to fight. We should be in a position to take the input tax credit, although payments are not made within 180 days, and thereafter litigate this matter. I'm fairly confident that we have a good case to fight. Next, the next issue relating to eligibility and conditions in respect of input tax credit on depreciation. All this you know. I've just given illustrations of section 16. I don't want to get into this anything else there because it's very simple concept. Time limit in respect of input tax credit. Please look at time limit in respect of input tax credit relating to debit note. I have given here a perfect case of what is the last day, crucial day for the purpose of debit note with effect from 1/1/21/92 of 2020, where this amendment came, where invoice of such invoice, that phrase was removed and now debit note has become absolutely clear. In the month in which you raise is a month in which the recipient will also be entitled to take input tax credit, and the last date for availment of input tax credit based on that invoices 5/3/2020 September 2020, 15/4/2020 is what September 2021. Look at that case. If you raise a debit note on 15/4/2020, you have almost 18 months, but if you raise the invoice 1 month before, you have only 6 months which is available for the purpose of availment of credit. Now we are pushing our luck too hard. Now this rule 36 is a headache. I don't know who gave them this idea of this 10%, 20%, 30% business. Now these are documents that are required for the purpose of availment of input tax credit. If the following are required in terms of rule 36, credit will become available. Please come to the right hand side of the slide. Invoice must contain all details specified. If I am an assessing authority and I want to harass you, I will tell you, please bring an outward supply invoice, that is your inward supply invoice, which meets with all the conditions specified in Rule 46. Rule 46 has 17 requirements. Please look at it. It has A to Q. A to Q is 17 requirements. All those 17 requirements must appear on the face of the invoice. If I want to deny input tax credit to you on frivolous grounds, if I want to deny input tax credit to you because I don't like your face, if I want to deny input tax credit because I want to harass you, then I will tell you, give me an invoice which fulfills all the conditions laid down in Rule 46. I want young child accountants to spend some time to see what this Rule 46 is and whether the invoice that you have in your hand suffices. 2 reasons. You can always come back to me and say, what sir, what are you telling me? There was a notification which was issued. That notification told name, address. That was a circular. Name, address, GST and serial number. If these 5 or 6 items are there, you will be eligible for credit. It's not necessarily. An assessing officer can bypass this circular. You can bypass the circular. So I don't want to follow this circular because I don't believe this invoice. Then you have to fall back on Rule 46. If the taxpayer has been paid by the supplier after order has been passed for demand. Now, if you look at Rule 36, Sub-Rule 3, Rule 36, Sub-Rule 3. Rule 36, Sub-Rule 3 says, if the supplier has been charged with a demand and he wants to pass on the tax element to the recipient, let's say it was a classification issue. Let's say it was a classification issue where we are charged 12%, but it is actually 18%. Actually 18%, and the supplier was inspected. There was a demand that was raised. Notice was issued under 73. Order concluded under 73. He cannot pass on this differential 6% to the recipient and say, you claim this input tax credit. Rule 36 Sub-Rule 3 bars this situation. It bars this situation. Rule 36 Sub-Rule 4. Please look at that first bullet point. It is such a painful process. I think the government should do away with this process. I am a very strong critic of law. This is not simplification of GST. They are saying 20%, 10%, 5% with effect from 1/2/21, bring in 1/2B, bring in 1/2A. What are we talking of? What is ease of doing business? I am saying if the government wants revenue, just make 18% as 20% and be done with this. Remove all these conditions. Forget all these conditions. You want revenue, change it to by increase it by 2%. Be done with it. But don't say I will allow only 5% if you have invoice. Don't have invoice, I will allow 10. If you don't have anything, you commit 20%. What is all this that we are talking? We are just messing up this entire law. Anyway, I don't want to waste my time on it. Now, look at bullet point number 3. Full input tax credit will be available in case of IGST and import. The first two will talk of restriction. On import, when you pay IGST, full input tax credit will be available. Tax paid in the RCM, full input tax credit is available. And ISD, full input tax credit is available. Look at this headache. If an assessor has to maintain such details, life is horrible. It is not going to be easy at all. Auto-populated details, last but one bullet. Auto-populated details in 2A, as on the due date of filing 1. Please be careful. It is as on the due date of filing 1. That is why when I answered that question which came in the chat box, I put the date as 10. It could be 11th, it could be 13th in some cases. Till that day, credit can be used. Another credit can be claimed in the subsequent month. Because you can always argue with me, sir, what can I do, sir? What can I do? This credit is not appearing in 2B, but it is appearing in 2A. If it appears in 2A, it will be available for the subsequent month. But available in 2B, available in the same month. This is what they have brought in as a change in the new provisions of law. Now this 36(4), this eligibility and ineligibility of this 10%, 5%, etc. I've given a detailed illustration here. I will send it to ICAI and I'll tell ICAI to put it up on the website or send it to each of you. Now 36(4), this reversal is the biggest headache. Now if you look at the notification which came, it brought in a new rule to allow cumulative adjustment from February to August 2020 because of COVID. Now whether reconciliation between 2A and ITC per book should be done on year-to-date basis or on monthly basis. Now hundreds of chartered accountants are asking me this question, whether the ITC reconciliation should be done on YTD, year-to-date. I am saying it is to be done on a month-on-month basis, period. It was a relief measure. You cannot take advantage of that relief measure. Whether the rule issued is beyond the powers of 43A, actually yes, the rule issued is beyond the powers of 43A. There is a good challenge which has similar provisions is not yet made effective. If you look at 43A, there was a 20% blanket ban there. They first said 20, then they made it 10, now they made it 5. Because they have not notified 43 capital A, they cannot notify it because the government is not ready with their website. They have gotten this through a rule. I think we have a fantastic challenge here. Whether the rule is intra-virus section 16, in my view, it is not intra-virus. I think we have a very, very good challenge before the High Court in respect of this rule. Please look at it however you want to see. Now, this is this 2A and 2B business. Whoever has asked that question, Rule 60 of the CGST rules was amended. It was amended. Once it stood amended, this is the Rule 2A and 2B conundrum. It stood amended with effect from 1/1/2021. With effect from 1/1/2021. What it says is 2A is dynamic because 2A will keep changing as and how the supplier uploads the information. For example, if I take last year March 2020 2A, it would be different from what it was when I filed the return because somebody would have uploaded GSTR1 now today in my name then, but I may have availed input tax credit on the strength of the invoice. On the strength of the invoice. Therefore, GSTR 2A is dynamic. This form gets updated on a real-time basis. On a real-time basis. But what happens to 2B? 2B is static. 2B is static. On 10th it will freeze, or on 13th it will freeze. So supplier filing GSTR 1, but 11th is a day or 13th is a day. It will freeze on that day. What is the source of information for 2A? Source of information for 2A is GSTR 167. Here also, source of information is 165 by the supplier, including details of imports, bill of entries, etc. from the ICAI. It will not include TDS, TCS. Therefore, although it is 1, it will freeze on 11th. That is the difference between 2B and 3A. 2B freezes on 11th. 1 is open for any amount of time. What are the additional details? 2A tells you status of filing form 3, filed or not filed. This will tell you details of GSTR1 filing date. 2B will tell you date of GSTR1 filing date. It will tell you on what date the fellow is uploaded. Status of vendor's registration as on date of generation of 2A, it will tell you. This will not tell you anything. Now 2A is monthly, relates to invoices of that month, where it is monthly but up to 11th or 13th, whatever that date is. Eligibility, it does not differentiate between transactions reported as eligible or ineligible, but here it will differentiate transactions reported as eligible or ineligible for the purpose of the rule, that's all, not for any other purpose. It will not tell you motor car is there. It will tell you this is uploaded before 11th of that month, therefore you are eligible to avail the credit. But it will not go and find out whether motor car is there or motor car is not there. It will not find out that. This is what you will have to be careful about. Now, if you look at the next transaction, I have given some illustrations of what will appear in GSTR1, what will appear in GSTR2A, in 2B, I don't know, and comments on eligibility of 2B, how it will appear. Please read through this transaction. You will exactly know how this transaction will appear in the system. What are the pointers that we need to take care of in 2A and 2B? What are the pointers that one needs to take care of? Now, ineligible input tax credit reflecting in 2B does not cover all instances. It does not cover all instances. You are required to take care and self-assess yourself about the ineligible input tax credit in 3B, because 2B will not cover. Whatever credit is there, it will show, but it will show only up to 13th. Therefore, you are required to take care of eligibility or ineligibility of input tax credit in 2A and 3B. The restriction on 5% of provisional credit will not be supplier wise. It will be linked to total eligible input tax credit reflected in 2B. Total eligible input tax credit. It will not be supplier wise. It is a basket and therefore it will be total. ITC reflected in 2B should be considered in the following manner. For suppliers filing monthly return, all transactions relating to GSTR1 filed before 11th, you are entitled to. After 11th, you are entitled to in the subsequent month. That's all. Subsequent month. 2B being static document, even a single day delay in uploading will postpone the eligibility or availment. Even a single day delay, that means instead of 11th, if you do it on 12th, 2B is static, it will freeze on 11th. 2A is not static, it is dynamic, it will still show. So on 20th, when you file the return, 2A will show higher input tax credit, 2B will show lower input tax credit. GST or 2A can be handy to identify status of filing of 3B, but 2B will not tell you. Now, year to date, 2A, 2B books to be maintained and reconciled on an year-to-year basis. Now, apportionment of block credits that we are talking of, input tax credit for business and other purposes. Input tax attributable to business shall be entitled to input tax credit. You shall be entitled and you shall be eligible. You can take the credit. Be careful. You can take the credit as eligible credit if it is attributable to business. Input tax credit for taxable including zero rated supplies and exempt supplies attributable to taxable supplies, you are entitled to take the input tax credit. There's absolutely no difficulty at all. Now, in some of these eligibility cases, what I have really done here, no, I think, yes, apportionment of block credits. I talked to you about nil rate, I talked about hotel, I talked about liquor, I talked about windmills, etc. Please be careful. This is how apportionment of block credits will happen in terms of Rule 41 and Rule 42. So exempt supplies, non-taxable supplies, nil rated supplies, you will have to apply this Rule 41 and Rule 42. I am not spending my time. Please look at those illustrations at your free time. I've taken some very complicated cases and given you. I am sure this T1, T2, T3, T4 business, you will be in a position to identify. Now, I have also taken one or two cases which are specific for the purpose of construction industry. I have taken because that will interest you. All these credits I have discussed in full. So there is no difficulty. You will understand month-wise, project-wise, etc. So you please read this. The way you understand or how you will have to reverse input tax credit, these are normal. There is nothing different or complex here. Whatever everybody else discusses in the available in the statute book, I have claimed here. This is the normal position of law that I have discussed here. Nothing more than normal position of law. Right? Now I will take some important issues before I close because my time is running out. I have only 10 or 15 minutes left, so I need to look at something different. Yes. Now look at this transaction. Look at this transaction. Motor vehicle input tax credit is restricted only if the approved seating capacity is up to 13%. Capacity up to 13% only credit is eligible. Capacity up to 13, credit eligible. Only if it is used for further supply of such motor vehicles, further supply, transportation of passengers, imparting training for motor vehicles. Now look at this restriction. If you are going to say you're a tempo trailer, that fellow will tell you, sir, I am actually taken permission from RTO for 14, including driver. Now here it says including driver 13. Now I don't understand why it should be 13%. You say eligible or not eligible, be done with it. If it is 14, I will not give you. If it is 13, I will give you. If it is 13 plus 1, you are not eligible. This is the problem that we have in GST law. I expected that the GST Council or the Finance Minister will ease out these headaches. These headaches are the biggest problem. Now, if these headaches are eased out, I think a lot of good will happen insofar as GST is concerned. Approved seating capacity more than 13%, credit is admissible without any restriction. Up to 13%, only in respect of those three cases. Above 13%, bus, guest, etc., it will be available in respect of all other cases. ITC on motor vehicles like dumpers, tippers, bulldozers, and the like is now allowed for the purpose of input tax credit. All these ships, vessels, etc. Let us not waste time. Credit will be available. Lot of issues. Lot of people have been discussing on general insurance, repairs, maintenance of motor vehicles. Now, I have bisected this up to February 2019 or January 2019, post-January 2019. Post-January 2009, that is from February 2019, credit will be available. Up to 2017 to 19, my view, credits will not be available. But some chartered accountants are of the view that input tax credit will be available without any restrictions. Post-February 2019, it was only clarificatory, is what chartered accountants say. You take your call, but I am saying up to February or January 2019, credit not available in respect of insurance, repairs, maintenance, and services of motor vehicles. Post February 2019, credit will be available. Leasing, renting, or hiring. Now, leasing, renting, or hiring. Be very careful. Leasing, renting, or hiring. You rent a building. You hire an auto rickshaw. You hire an Uber. You rent a Zoom car. You rent a bounce. Therefore, renting, hiring are two different things. Now, I have had various discussions with many of my friends. I have now come to the conclusion that the distinction between leasing, renting, hiring is this. Leasing is a transaction where there is a transfer of right to use and that transfer of possession of the movable property or immovable property. That is a transaction of lease, the case of movable property. Renting, where you know the time period or you know point A and point B. Where you know point A and point B or you know the time period. You rent a building because you say it is for 9 months, 11 months, 3 years, etc. It is not a lease, therefore you rent. You can lease movable property, although you put immovable property in possession, it becomes a case of rent. Now, renting an auto rickshaw is one because you tell him, please take me to Mount Road, please take me to A place, please take me to B place. Hiring means you take it on hire for 3 days. Do what you want. Please be careful. Zoom car can be hired with a driver. Zoom car can be leased without a driver. Same way, Uber is hired, rented because you know the destination. You hire. When you call up a travel agent and say, I want a cab for 3 days, you can take him wherever you want. So that is a subtle distinction between leasing, renting, and hiring. Once you understand that, then please read this slide. You will exactly know what is the situation. Food, beverages, etc. Lot of it has been talked, so I don't want to spend any time. There is nothing that is there in respect of issues so far as these food, beverages, etc. are concerned. Now, blocked credits. I want to spend 1 minute in respect of this blocked credits in respect of 17.5C and 17.5D. Please look at that. In one place it says plant and machinery in 17.5C. In 17.5D it says plant or machinery. Please look at that very subtle variation in 17.5C and 17.5D. In respect of blocked credits, it says plant and machinery or plant or machinery. Now, if you look at the right hand side of your screen, we have talked about safari retreats. Now, there are several matters that are pending before various high courts. In fact, in a few of my clients' cases, where they have taken shelter under safari retreats case, Orissa High Court, where input tax credit in respect of work contract, Orissa High Court said you can take the input tax credit because output is being subjected to tax in case of malls, right? So in many of these cases where the construction of commercial complex has taken place, we have challenged this before various High Court, including in the case of Bagmane Tech Park in Karnataka, where the Karnataka High Court said that subject to 10%, you take 90% credit, 10% you leave it in the input tax credit portal. You will not be allowed to take the credit in respect of 10%. Fair enough, no difficulty at all. Now, in so far as the other cases in Telangana, Chennai, etc. are concerned, applications are filed by advocates to tag it along with the safari retreats case, which is now pending before the Honorable Supreme Court. Therefore, this matter is very interesting. We are in for some beautiful decision from the Honorable Supreme Court, hopefully in our favor. Now, look at this advance rolling. in the Tarun Realtors case. Karnataka is an expert in litigating, whether it is the SSC or whether it is the appellate authority for advance ruling in Karnataka. Look at how they have treated this transaction. Please read bullet point number 3. He says chiller, air handling unit, etc. equipment do not qualify as plant or machinery. They don't qualify as plant or machinery, but are items which are procured for the purpose of construction of immovable property, without which you will not get an occupancy certificate. Therefore, you are not entitled to input tax credit. I am saying my chiller, my air handling unit is plant and machinery. They are plant and machinery. They may be required for the purpose of obtaining the completion certificate or occupancy certificate. Does not mean that they are not plant or machinery. Therefore, I should be entitled to. Unfortunately, the assessee did not pursue this matter before the High Court. Now we are stuck with the appellate authority's ruling, and we will have to live with this until somebody else chooses to fight. Now look at the second part. First one, he said it is not plant and machinery, it is part of land and building. But look at the second one. In respect of sewage treatment plant and in respect of water treatment plant, he said they form part and parcel of the civil structure of the immovable property. Civil structures are specifically excluded from the definition of plant and machinery. Therefore, DG set and transformers, they said are procured as independent items, and their installation becomes part and parcel of the civil structure. Who said so? DG set and transformer can be dismantled and taken wherever you want. They don't become important. Without a DG set and transformer, you can still get occupancy certificate. You need not give power backup for the purpose of construction of an immovable property. What is wrong with this appellate authority? They said it forms part and parcel of the immovable property, and therefore the appellant is ineligible or not eligible to avail input tax credit. I'm afraid that this is an incorrect advance ruling. We need to have fought, but we have not fought. Input tax shall not be available in respect of the following. Input tax credit shall not be available in respect of the following. If the inward supply of goods or services or both are received from composition, there is no difficulty at all in understanding this section 17. There is no problem. It is just straightforward section. Now here, please spend a couple of minutes on the samples and gifts. I have a problem between sample and between a gift. Consider this case where Geeta Madam goes to a shopping mall in Bangalore or in Chennai. The moment she enters the shopping mall, one of these store gentlemen will come and he will give Geeta Madam a juice, a glass of juice, and he will say, Geeta Madam, try this juice. Now, you want to call it business promotion, you want to call it sample, you want to call it advertisement, depends on the nature of the transaction and how you book those transactions in the books of account. If you book those transactions as samples given in a shopping mall, you have to reverse input tax credit. If you book that as business promotion, you are entitled to input tax credit. Take this case where a Clinic shampoo sachet is pinned to your Times of India and delivered with the newspaper every day morning. You want to call it sample, you want to call it business promotion, you want to call it, for example, advertisement. Depends on the nature of the transaction and how the company looks at it. For example, if Clinic shampoo is being marketed in a place where it was not available, then you can look at it as an advertisement and book it. But in the case of juice that is given to Geeta Madam, can you turn around and say that it is a sample or it is in the course or furtherance of business, transaction to transaction? We will have to take this call. Buy one, get one offers, be very careful. Buy one, get one offer. It can become a mixed supply. It need not be a composite supply. It can become a mixed supply. You need to be very careful. Discounts including buy more and save offer also. I think I've covered it adequately here. The secondary discount transaction also is very well covered. I don't think the circular was withdrawn. No difficulty. The distinction between sample and free supply, I have brought it out here. You can look at it whenever you want, whenever you find the time. All that I've explained to you. All these credits available in special conditions. Voluntary registration is straight from the statute book. There is nothing new, nothing important that has happened here in respect of input tax credit mechanism, including composition dealers under section 18 when you cease to be a composite dealer and move to payment of tax under the regular scheme, supplies of taxable transactions, change in constitution when a partnership becomes a proprietary becomes a partnership concern or a company, etc., etc. How do you move credit from A point to B point? Section 18, there is no difficulty when you shift from composition to exempt goods or exempt goods to composition. It's a straightforward section. Please look at that example, you will be able to get it. I don't want to get into routine matters because my topic was on issues. Manner of reversal of input tax credit. This is an example that I've taken. Please spend some time. My mail ID is available with the ICAI. If you have any problem, please send me because I have taken a completely different view here. And this example will tell you when credit will lapse. You are free to look at that example and take care of input tax credit. Job works under 143 and section 19, absolutely straightforward provision, no difficulty at all. Resident Welfare Association, no difficulty. Rule 45 says 1% to the value of security in case of shares, etc. No other issues here. Normal wastage, etc. Not to worry at all. I have covered all this in my session, first half of the session. This input tax credit in respect of crop charge, I have handled this. This is straightforward from the provision. There is no difficulty at all. The last part of it where I have talked of is in respect of input tax credit, whether it is exclusive or inclusive of tax. Rule 35 is perfectly possible. In case of hotel, I've taken some issues, shelf life expired goods, spend some time to figure out how you will want to handle these transactions. These are very, very interesting issues in respect of credit. I have in fact told you when I handle these restaurants and hotels, I have told you that you will have to report gross. You have to report gross. And after reporting gross, reverse input tax credit to the extent you have reported gross. But valuation in each of these cases becomes very, very important. Otherwise, corresponding input tax credit will go up. If you are saying complimentary airport drop, I will not give you input tax credit. If you say room tariff includes airport drop, then I will avail input. Then I can avail input tax credit because room rental includes airport drop. So how you are going to package your room rentals becomes extremely important in each of these cases. So I think in the time that was available to me, I have tried to cover as many issues that are possible, and I have tried to give my view. You may disagree with my view, doesn't matter. It doesn't matter. You are entitled to disagree with my view. You are free to disagree with my view. But I have given you my view, keeping in mind the issues that will come up 2 years from now. I want you to get ready with the issues, and therefore your defense mechanism will be good. Now, I have 2 or 3 issues that I will have to share with you. I have been part of several committees of the government, both state and at the national level. The indications that I get, while I cannot tell you what was discussed, who was there in that meeting, etc., the indications that I'm telling you that I'm getting is definitely going to hit the future of this profession. Take it from me. What you are doing today by way of compliance of matching invoices with 2A, with 3B, with 2B, with which you are so much concerned, technology is going to do it from 1/4/2022. It is going to do it from 1/4/2022. Starting now, we just have 12 months. Trust me, I have seen some of these demonstrations, and some of these demos are beautiful. So you are not going to have any professional work starting 1/4/2022 for compliance, because your 3B will be auto-populated. Your 3B will be auto-populated. Only matters beyond 3B. Trust me, if there are 1,000 entities, there will be only 10 entities where matters will be beyond 3B, where you have to take a decision and give consulting. In no other case you will have this. So the way forward that I see for this profession should be consulting, advisory, and litigation. Technology is going to take over. Now, as our past president said, the 2 crore became 5 crore, became 10 crore, and so far as tax audit was concerned, we now have 500 crores, which was on e-invoicing basis. reduced to 100 crores. Trust me, April 1, if not April 1, June 1, if not June 1, September 1, it will drop down to 10 crores. You will have e-invoicing which will be moved to 10 crores. What more work is left? Everything is going to be auto-populated. Compliance is not going to be the practice that you are going to be in. The future of the profession is not going to be audit. In fact, you will dislike me, you will abuse me if I tell you the audit that we are doing is really not an audit that we are doing. I think we should concentrate on legal issues. That is what the chartered accountants are trained for. We should not be looking at compliance matters at all. To move to the next level of practice, I think we should be in classification, we should be in litigation, we should be in consulting, we should be in drafting and conveyancing insofar as GST is concerned. That is where the future of profession is. That is where the value of your time is. In compliance, you are only going to be crestfallen every single day. I did so much of work, he's not paying me more than 10,000 here. I don't want you to do that work. That is how I am looking at it. Whereas you will be turning around and telling me, so what is your problem, sir? After 30 years of practice, you got all the files. Therefore, you can talk whatever you want to talk. I am not talking whether I have the file or you have the file. I am only talking where the future of the profession is going to move in the next 1 to 3 years. Trust me, compliance practice is going to move out of GST. You will have only advisory, you will have only litigation. All these fake invoices will vanish in the next 1 to 2 years. Take it from me. Technology is so advanced, you are not going to have fake invoices in the coming years. Everything is going to be tied up through machine, and we will have no work other than consulting. Thank you, delegates. Thank you, chairman, treasurer, committee members, and the secretary of SIRC of ICAI. Thank you so much for giving me this opportunity with abundant time. Any questions, please put it. I will mail both these slides to SIRC of ICAI right now after I finish this session, and I will request them to mail it to everybody. Thank you so much.
Sir, I'll just share.
Thank you very much, sir. A few questions we have from members. Selva,
Yeah.
can you share the questions on the screen?
Yes, I'm just sharing it on my screen, ma'am.
Yes.
In this, the second question is already answered, sir,
Yes.
while taking the session. The first and third to be answered.
Yeah. Is it possible to get a GST number on your PAN, even if you don't apply for a GST registration? There are 3 GST registration numbers. One second. In our client's PAN, the 3 GST registration numbers. However, he didn't apply for the remaining 2. Now, Nidhi madam, the only answer that I can give you is how could these 3 have come? One may have come on account of migration. When you have migrated from VAT to GST, one may have come. Probably the second came on account of migration from service tax. The third probably would have come from migration of excise. Therefore, these 3 may have come. I may be wrong, but this is my view because an exactly similar position happened to my client in Bangalore, and therefore I'm telling you this is how it would have come. You might not have applied. The only way you can do it is surrender the 2, keep the 1. Now 2A is over. In quarterly return, yes, question 3. In quarterly return monthly payment scheme, the small suppliers file the return quarterly. Correct. Quarterly filing, monthly payment. Now, if I am receiving goods from such suppliers, purchases, and ITC will not be reflected in my 2A. Correct. 2B. Because the same is blocked for the supplier on the other end. Yes. How to take ITC on such purchases? This will block our working capital. Now, Nidhi madam, I can only tell you, don't go through the QRMP scheme. If you go through the QRMP scheme, ITC will be blocked for the 2 months. But it is only a working capital issue for 2 months. Because in the 3rd month, you will get the input tax credit of the first 2 months also. But if you want to follow the QRMP scheme, this is the scheme. It is an option given to you and it is not mandated. So if you choose that option, this is what you will have to look at. Yes, sir. Next question.
So those are the questions, sir. Okay, that's it. And the last one is compliment one. That's not a question, actually.
Thank you, sir. Thank you so much. Thank you so much. Yes.
And, yeah, that's it, ma'am. You can take over. Geeta, you're muted.
Thank you, sir. On behalf of SIRC, I sincerely thank today's speaker, CA Venkataramani sir, for accepting our invitation to address our members for this conference. And sir, your presentation and explanations were eye-opening like always. And you have enlightened us with various possible instances that may arise with regard to ITC, starting from invoices, HSN code, block credits, common credits, and many more. And I'm sure we all will remember you when we are confronted with similar issues in the future. And I also thank my professional friends who have joined this program and shown their keen interest in learning and updating, thereby paving the way to uphold the quality of our prestigious profession. And Sir Venkataramani sir, thanks again for this marathon session of 3 hours non-stop, and that too covering from invoices to advance rulings, circulars, notifications. And again, thanks again for your valuable suggestion and giving us an alarm signal to our professionals about our future of our profession. Thank you very much, sir.
Thank you, sir.
So my dear friends, with this we come to the end of the first day of Metro Conference. See you tomorrow at 5 p.m. for another interesting session on blockchain and artificial intelligence. Stay safe and good night. Thank you.
Thank you, everyone. Silva sir.